I'm going to go ahead and get started. Hope everyone is doing well this morning and ready for day 2. We're going to do a little bit of review and then move into more of the volume profile. One thing I will let you know, I think some people sent me email last night. I messed up in my email access, and so we're working to get that back. So if I didn't respond to you, I will once I have that access back. I just wanted to let you know that I was not ignoring any email. All right, so let's go ahead and take a look and get started here with with day 2. And again, I want to talk through what we're going to be looking at today and the things that we are going to go through. Specifically, the volume profile relationship to order flow. We're going to look at building market context using the volume profile, and then using principles over time. And then we're going to have a test later today. The other thing we're also going to go through is the elements of the volume profile and the attributes of those elements. So we're going to actually start talking through, go through a review of yesterday, and we're going to go through the elements of the volume profile and then the attributes of those elements, and then we're going to take a look at volume profile examples, and then we're going to get into current market scenario and get to start putting a few of those pieces together. So the first thing I wanted to do is review day 1. This won't take too long, but just to recall from yesterday, the market is really defined as all active buyers and sellers. So, and we've talked about this. I know DB has certainly brought this up, and historical information relative to the market is always good information to do planning and good information to look at specific areas. However, it is a point in time active buyers and sellers that will determine price movement at any given time, and that's the frustration of the market, but it's also the challenge and fun of trading in the market, is that nobody really knows what will happen next, and but it is determined by active buyers and sellers at any given point. And they are the only ones that can move price at any given point. And our job as traders is first to be risk managers. It is really all that you control is your risk. You can't control the trades that come in after you place your order. You will inherently improve your trading when you learn to trade with market participants and manage risk objectively, not hopefully. And what that means is being able to learn to read the print, first identify the areas you want to get in, read the print, and then use the print and order flow to effectively and objectively, more importantly, help to manage your risk and your profit. Again, order flow is the interaction between the buyers and sellers, and it also provides us with context over time. And context over time is what is the market trying to do, and how effective is it in its attempt. And then also a point in time context. And basically what we're looking at that point is, does the print confirm the trade? Am I seeing what I want to see between buyers and sellers to get into a trade? Some of the principles of an auction that we talked about yesterday. First of all, price will continue to move in a specific direction until the other side steps in to shut that movement off. Now, this is true whether we're looking at the ES on a late August day and we're moving up and down in a 2.5 point rotation, or we're looking at a CL chart and we're moving up and down in a 50 tick rotation. The market will continue to move in a trend day, in a rotation day. If we're looking at a balanced day where price is moving up, price is moving down, we can see the rotation beginning to occur. We can see it in the volume profile. Then at the bottom of that range, it's likely to move up. Top of that range, likely to move down until something else happens. Either one side steps in to continue that move. Otherwise, it's likely that the other side's going to step in, shut that movement off, and turn it back around. The market will move from balance to imbalance. Every market does this, and there are never more buyers or sellers, just more aggressive ones. As a process for context, some of the things that we're watching when we're trying to gain context from reading the print, we're watching these things. Where unusually high volume comes into the market. We're looking at things like the volume cluster analysis. And I'm going to show you a very, very simple tool that I use just as kind of a trigger or an alarm when high volume is coming into the market. Sometimes if you're looking through the print and you're looking at all the numbers, sometimes it's evident when more volume is coming in because every bar has a volume cluster. It may not always be evident when a significant amount of volume is coming in at any one time. And I've got a very simple tool that I use to alert me when that's happening. So we're looking at when and where unusually high volume comes into the market. Again, the volume cluster analysis gives us the ability to see where volume is coming in bar by bar, and also what kind of volume it is. And then we want to make sure that we understand what the effect of that volume is having on price. So for example, if we can see that we have a green volume cluster analysis, we know that a lot of contracts are hitting at the offer, lifting the offer, lifting the offer. What we're looking for inherently is, will that move price? And if the answer is yes, they're being effective at moving price, then we're looking higher to see where sellers might step in. If the answer is no, they're not very effective at moving price, we can see that the buyers are being held, then we want to take note of that too, and we might want to look lower. But depending upon when that volume comes in, where it's coming in, and what the effect is of that volume on price will give us information about whether we want to, if we're in a trade, whether we want to get out of that trade, extend that trade, etc. But again, it's market-generated information, and it is information that only comes from the market, and that high volume, when the market generates more volume, it is usually a great sign for us and a great tool for us in our trading. We also want to take a look at where buyers and sellers relent, typically shown by weakness in the print. So if we see price unexpectedly start to move lower, for example, and we look at the print and we can see that the sellers have relented, meaning there's just a lot of blue numbers, but also not just blue, but they're lower numbers. We can see that, in fact, sellers have stepped aside, so to speak. We want to make note of that, and what it's saying is in that area, buyers don't see value, and we want to, as part of the auction, understand and make note that that is an area for the day at that point in time of weakness by the sellers. And so we'll want to see if price does pull back to that area, if we get continued weakness by the buyers. If we get continued weakness by the buyers trying to push price up, selling come back, price is moving lower. If price is moving lower, sellers have relented. If price is moving higher, buyers have relented. When price pulls back, we want to see that weakness begin again to take a trade in the other direction. We also want to take a look at the print on the high and low edge of a rotation. So if price is in one of those 3-point rotations, it's moving up and down, or 5-point, whatever it might be, we want to look at the edges at the print. At the top, we want to see if there's weakness to the offer, strength back to the bid. That would be a good indication of an opportunity for a trade short. And at the bottom of that rotation, we want to take a look and see, of course, if there is weakness at the bid, strength back at the offer, which may give us an opportunity for a long back towards value, VPOC, volume point of control, and potentially back towards the top. So those are areas and things that we're looking for. The other thing that I mentioned yesterday was, especially in the ES, the pre-market transition, which is from about 7:20. It's different days to days, but I'm starting to look for evidence of the U.S. market starting to impact or come into the ES around 7:20 to 7:45 Eastern. And I start to watch what happens to the auction, what happens to price with that additional volume, and that starts to set the context for me for the pre-market, potentially a pre-market trade. And let's say, for example, I can see buyers coming in around 7:20, and they're having an effect on price. They're actually able to move price, and then price moves down, price moves up. We see this rotation, but I also see buyers holding any specific area on any pullback. Then my mindset, not a bias, but my mindset is these U.S. buyers have been trying to push this market up. I need to look below. I might put a little bit more weight on a long opportunity in a trade plan that I have, looking for a test lower. But then the open starts to become very important, and what I'm trying to do at the open is confirm if that's still the case. If it is, then I'm typically looking for longs on a pullback, and if something changes, then I will adapt my trading plan. So if we're using the print as a process for trade entry, remember we can use it as a process for gaining market context and also as a process for trade entry or trade management. These are the things that we're watching for. Specifically, the activity at the bid and the print at two different levels, at least two different levels, if not three. And I talked about that yesterday, showed you an example of that, and I can bring this over just to go through what I'm talking about again. When I'm talking about looking at the print at these different levels, let me see if I can expand this a little bit. So price comes down to this level here. And by the way, this was our open range yesterday between 24 and 22, this 2250, 75 level. So as price came down, let's say I'm looking for a pullback and a short. I see the weakness at the offer. I see the strength at the bid. And yesterday, if you remember, a pullback occurred. I was looking for a potential short, but there was strength one further down, one level down, strength at the offer, weakness at the bid. There was strength at the offer, weakness at the bid. So I look a couple levels deeper just to see what the buyers and sellers are doing. And in this case, I would need to see strength coming back in at the bid, and I would need to see the weakness at the bid going away. So in order for me to get short. So I'm watching the auction not just at this level, at the top of this rotation, but I'm also watching it two levels lower. And remember, there's always two prices. So the combination that I'm watching is the relationship between this 25.50, 25 quarter, 25 quarter, and 25. And as this, again, this represents an opportunity, and this was a low volume area for the overnight at 25.75. So this was an opportunity, and this is the setup in the print that I would be specifically looking for. I want to see buyers begin to get weak. I want to see sellers start to get strong at this low volume area, and I can show that to you. We're going to get into this today, so so this is an area that I would look for the sellers to start stepping back in, and they have. And what I can see now is there's not really much conviction on the part of the sellers yet, not much conviction here. And so I would start shoring up this trade and making sure that I did not lose on this trade. I can see strength coming back into the offer here. Even though we have a selling cluster and a selling cluster in the volume cluster analysis, what the print right now is telling me is the selling that occurred up here, I don't see the same strength as I did. And the other thing that I don't see is the weakness again in the buyers at the offer. I'm seeing strength come back into the offer, and what I don't see yet is the strength back into the at the bid with the selling. What that tells me is if I were into a trade here, let's say at 25.50. Not that this trade wouldn't work, but the market information is telling me that this is at additional risk. It's not saying it won't work. It's just saying that there's additional risk to that trade, and I would need to watch carefully as to how the auction is developing in the print. So that is one of the ways that we use the print specifically at the two levels to identify trade entry and then trade management. Right? Do I want to take more profit? Am I at risk of getting stopped out? And then manage objectively. I mean, and I can tell you that when I have these tools, I don't feel like I can control price, but I know that I can control my risk. And when I can control my risk, I have some sense of control, and I can stay objective. I'm not nervous or anxious in a trade because I at least have that control. So if an example here, if I'm long, like I just talked to, well, if I'm long at the bottom, I want to see weakness at the bid, strength at the offer. And like I just showed you, if I'm looking for a short, I want to see weakness at the offer and strength at the bid. And I want to see that at my level that I want to take the trade. But I'm also, again, making sure that I'm looking 1 to 2 levels below that, and that I'm also confirming that if I'm short, that buyers are in fact relenting and the selling or activity at the bid is increasing. Does that make sense? Yep. Okay. I know it's early and we might be a little slow in getting the cobwebs out and getting going. So I'll stop a couple of times and just ask that question as we review. The print and order flow is the only truth that you have in the market, and I made comments to this yesterday. Specifically, this is very foundational and key. It is the only thing that you can hang your trade on, kind of hang your trust in, because it's all that you have that you know. There's nothing else that you know in the market. You don't know if buyers are going to step in here. You don't know if sellers are going to step in here. You don't know what's going to happen to your trade. And again, it's one of the crazy things about trading, and it's one of the great things about trading, depending upon your personality. But understanding this really is the first step in achieving greater consistency in your trading and managing your risk. Learning how to read it for context and trades is the second step. So I think that most of you can see, like the example I just showed you in reading the print, that it makes a whole lot of sense that if I'm looking for a short, I want to see weakness at the offer and strength at the bid, and if that changes, when is a trade at risk, and when is it likely to continue to work? Let me just bring this over here. So again, in reading this print, my system is a little bit slow to respond this morning. In reading this print, right, this was a level, this is a low volume area from the overnight volume profile, low volume area. So this is where I'd be looking for, and we're going to talk through what low volume areas mean and why I'd be looking for a trade there. We're going to talk about that today. And as price started coming back down, again, what I saw, weakness at the bid, even though there was some strength. And this even gave me more concern, or said I had higher risk. We had strength back down, relative strength back down at the bid, which was met by relative strength. Remember, at any given price, the bid and the offer can both be strong because we're comparing it horizontally. So there was not only relative strength at the bid, but there was relative strength at the offer. And then we had the green volume cluster and price starting to move up with weakness back into the bid. So what that meant is that this trade, again, at 25.75, or let's say I got in at 25.50 on the short, was more at risk. And just to be real clear, what I don't know if sellers will re-engage at 25.50 and push this down to 1920. That very well may happen. But I am not paid as a trader to predict the future. I'm paid as a trader to watch the print and respond and manage my risk. It's only by doing that can you survive the day, survive any drawdowns and losses, and come back another day. So one of the things we're going to get to this week is as you get into trade and you look at trade management, you're going to get to the point where you identify if your risk is increasing in a trade. It doesn't mean that you get out of a trade, because you may have a range, you may have a stop 5, 6 ticks away for a good reason. It doesn't mean if, for example, I'm short and we get strength back in at the offer, it doesn't mean the trade won't work. All it means, and what you have to get yourself trained, is see it and understand it as a higher risk. That's all. And then you watch the print and you stay objective, and then you make a decision based on what's happening in the auction. Right. And I can't stress enough, remaining objective in your trading is one of the, it's not a secret, it's one of your greatest advantages in overcoming any psychological issues you have in trading. So if you get into trades and you feel, and we're going to talk more about this when we go into psychology, but if you get into trades and you often find that you feel anxious, you feel nervous, you feel my trade is just sitting there, I can manage my stop, but I'm managing my stop based on price, where price is, not anything else, then the number one thing that will correct that for you is learning how to read the print and the order flow to manage your trade and stay objective. So doing this is the first step in reading order flow, and then spending time with it and learning how to read it, reading the order flow for context and trades, that's a second step. Because once you can do the first and you start to understand how risk increase, not even risk, but what the probability is that price will move higher when the print starts looking like this, and what the probability is that price will go lower once the print starts looking like this, then you can start to put those things together to build context over time. And you can start to see points in the auction, even just in the print, points in the auction where you can say, yeah, this is where buyers are holding, or yeah, this is where sellers really have conviction. And that will help you in getting confluence for trades. All right, so let's talk a little bit about the different objectives for today. First of all, I believe it's important to understand the history and the role of the volume profile. I mean, why are we even using this thing? Why is it so important? Why do I talk about it so much, give it so much credibility? The history and the role is important to understand. And then I want to talk about the elements of the volume profile, and then understand the power of the volume profile across time frames. Remember, one of the things that I talked about yesterday, one of the principles of any market is that there are different participants with different objectives in any given market. And when I say objectives, I mean entry points and exit points. So we know that there are participants who are looking to hold on contracts longer than a day, and they're looking for different price objectives. So understand how to utilize the volume profile across time frames to gain confluence of the different participants and find those areas that are really likely to give you a great trade. In fact, and we've been in nosebleed territory on the ES and all new highs for some time now. But when the ES was back down towards the 1500s, when I had confluence across the different time frames, long-term, mid-term, short-term, I didn't even need to wait for the print. I could set my limit order a tick ahead of those levels, and a high percentage of the time I would get taken in before I knew it. I had my first target and my first scale out of the trade. They are truly that powerful. In fact, I used to, talking to a friend and going through this, I had a friend once, excuse me, I had a friend who used to call them Moneyball because they just worked that well. My point is that when you start to understand the confluence of these levels across the different time frames, because there are different participants in the market, they become incredibly powerful levels for trade. So understand the volume profile in the context of the auction process. So how does the auction process and order flow actually build the volume profile? And we're going to talk about that a bit today. And then understand how to use volume in building a trading plan, placing trades and trade management. And when I say volume, using a volume profile and building a trading plan. So some of the volume tools that I want to go through and talk to you about are this thing called a composite volume profile. And a composite volume profile is a volume profile over a longer period of time. Composite just means things put together, and the things are days. So when we put days of volume profiles together or days of data together, we call it a composite or a group of volume profiles, all shown as one profile, and I'm going to show you how to create that today. But that's a composite over a longer period of time. I've been in some rooms and some places I've heard referred to as micro composites, and everybody has a different name for it. And we're going to try not to, except for composite and developing or daily volume profile, we're going to try not to focus so much on labeling the volume profile names as making sure you understand what data you want to include in your volume profile for a specific period of time. That's more important than the names. I don't care if you call a composite volume profile a long-term volume profile, whatever makes sense to you. The composite volume profile also shows longer-term volume levels. So volume points of control over a longer period of time, fair and unfair prices over time, and I'm going to show you why those are important for us. It can be a specific range of days to see the high and low volume areas of a specific auction. I'm going to show you an example of that today based on the recent move down in the ES, and identifies unfair highs and unfair lows of the longer time frame participants. Remember, longer time frame participants are typically those that have a lot of money. They are able to move price, and where they see an opportunity and you can trade with them, you're most likely going to win, because trading up against some, Dalton calls it an other time frame participant, a longer time frame participant, those that have more money and can move the market. When you're trading with them, it's not likely that you're going to lose. And so being able to identify what their unfair highs and lows are becomes very important. And this is just one tool. The composite volume profile is one tool in identifying areas of opportunity for trades. The market is every market is incredibly dynamic, and anything can happen. You know, the old saying that the market can stay irrational longer than you can stay solvent is very true. That's why you want to eliminate your bias as much as possible. But this is one tool, the composite volume profile, one tool. We're going to go through others in identifying areas of opportunity for trades. Another one is a shorter term volume profile, and that can be defined in terms of monthly, weekly, daily, and intraday. So for example, if the ES, something happens, the ES comes back down to 1,500, 1,400, 1,300, and that is likely to happen at some point in history, in the future. And when it comes back down to those levels, we're going to have a significant amount of data to work with, data that runs back 10 years. Now, somebody might say, how relevant is 10 years old worth of data? And it's relevant to a point, and I'm going to show you how it is relevant to a point. But we always want to use the most current data for our trade because that represents the current market participants and their beliefs, their convictions, their where they don't want to trade, their fair prices, et cetera, et cetera. But we use longer term profiles as reference points to say, okay, historically, this is an area, some people may call it support, resistance, whatever. This is an area where buyers see an opportunity. If in the current market, we're going to identify it in the current market, it shows an opportunity as well, then we can act on that. But they become very strong confluence factors for trade opportunities. The one thing you want to make sure that you include in a volume profile is at least the last swing high and the last swing low, or the last swing high and low. And let me show you what I'm talking about with that. So I showed you yesterday how to build a volume profile. In a second, my system is really slow. It's coming over. All right, so here is a structure chart, and this structure chart is back all the way into the beginning of June. So it's 90 days of data. And let's move this over. And look at what we might do. So if we were trading back here at the beginning of July 9th, and this was our market, right? Everything was kind of moving up. And we're going to draw a volume profile. We'd want to draw it from this level right here. Right? You can see resistance turns into support. We want to draw it and include this data and all the way up to where we might be, right there. So what we have is a little bit of a swing low, swing high, a pullback. I wouldn't even call this a swing low. A pullback, another move higher, another pullback. And we'd want to identify our low volume areas, our high volume areas, et cetera, et cetera. We want to say, do we have a finish? And we're going to talk about these elements today. So a lot of things that we'd want to do with this data. But what this data doesn't really represent, this data doesn't really represent a strong push by sellers. These pullback areas were likely just profit taking. You can see buyers stepping in to support these levels here, push it back up, likely took profit, which is why price comes down, pushed it higher again. So this volume profile up to this point only contains the sentiments of buyers. So what happens when we finally get responsive selling in this market and sellers start to push? It means that some areas like this area at 1964 may not be a low volume area to sellers. In fact, we may see on the way down as the market starts moving lower, this whole area filled in. We may see a whole day of volume filling in this area, maybe 2 days, where we have rotation to give us a better distribution. And we're going to talk about that later. So, but when I talk about having a swing high, swing low, what I really care about, now price, see where price came back down to this level? Right there, you can see that we had a bounce. So historically, this is good evidence of historically where longer term charts can show us interests that occurred before. And what we'd want to see is, is this still an area of interest for buyers? And if so, and if buyers start holding again, and we're going to go through this again today, but I can tell you over the next course of the week or several days, this is where price is coming right here, back to 1953, back to VPOC. because this is the most fair price for buyers. So one of the things that we want to look at is this swing low. We got this low volume area right here. In fact, you can see right here we have a low volume area just for this move up. Now what I want to see is, now I have a swing high and a swing low. So I want to include all of this data. And what you can see in the overlay, the previous one is this darker area, of course, but what you can see in the overlay is, as price starts moving down, I have VPOC up at 1967.25, whereas on the way up, it was at 1953.25. So with this additional data, volume point of control, or the most fair price in this market, has moved up. And that inherently tells me something about price if we start seeing it get through this level right here. Now, I also can see some confluence or agreement as price move lower that this is an unfair high and low. Right here, I'm looking right here. In fact, I can draw this line here. We're going to go through this today, so don't worry. You're going to see this many different times. This is what we're really going to focus on. So if you feel like you may not be getting it right now, do not worry. We're going to go through this a lot. My goal is, by the time we're done, you're kind of saying, yeah, I get it. So this is a low volume area, and what I want you to see is what happens to price. First touch, we get some rejection. It breaks through hard. We move up to this low volume area. Rejection comes down. I mean, is this a good trade? It's a great trade. Comes up through that low volume area, comes down, moves back up, finally comes through. Anyway, and we can see as price moves lower, there's an initial bounce off of this level. Another attempt by buyers to push us higher, and once it fell back down through, it was gone. It was done. But after it moved back up yesterday, where did it stop? Where was the high of the day? High of the day yesterday was 37.50. Look at that. I mean, that's to me, that's pretty amazing. Somebody has no audio. Can other people hear me okay? My sound looks to be working. Can you guys hear me? Yep, okay. So go ahead and log out and log back in again. There was a question here. Wouldn't the bottom of that low volume be around 34.75? There is a low volume area here at another one here at 31.25. So I would also, we're going to go through this, so I don't want to get too involved with that. And the point of this is to say, once I have a swing high, and then price moved higher and lower, and a swing low, I now have a good reference volume profile that I can, with a little bit more accuracy, start looking at the unfair highs and lows and consider them a little better reference points for potential trades. Now, the other thing, once price moved up above this level that I had, is as price was spending a month or longer up in this area, I had a swing high, swing low, swing high, low. So what that means to me is as I start building this data, say we get up to this date, this starts to become a very important profile, and I want to continue to see how this profile develops over time with these swing highs and swing lows. The longer it stays up in this area, the more valid these levels are. More valid the high volume and low volume areas, meaning the high volume areas are likely to attract price. Once price gets back up into this area, say above 45.25, then we're likely to see price move back to 52.25 and back up to 67.50. Now, I'm not saying it will, because this is an area that it needs to get through right here. But when I have swing high and a swing low, I have good data for my volume profile, because I can now see the interests of the buyers and of the sellers in any given swing. And again, we're going to go through this a couple of different times. So if you don't, if it's a little fuzzy right now, don't worry about it. So last swing high, swing low, I want to make sure I have that. Even if I'm looking at an intraday chart, I want to make sure that I have a profile for a swing high, swing low. If I have a trend day, and we're going to talk about what a trend day looks like in the volume profile, that's okay, because I'm going to use the profile shape for a trend day to provide me with levels. All right, short-term profile also shows unfair highs and lows for shorter-term market participants. Remember, don't ever forget this. When you click on buy or sell to get into a trade, that moment of truth, what you care most about at that point in time are the current buyers and sellers. I mean, it's great to draw all these profiles and create the plan and say, here's where I'm looking for buyers to step in, here's where I'm looking for sellers to step in, here's where I'm looking for a continuation on a trend trade. It's great to be able to do all that, but once you click the button, there's that moment of truth. The most important buyers and sellers to you are the ones that are buying and selling right after you get into your trade. And so relative to weight, and people ask me about this because we start talking about different time frame participants, what is the most critical, or what do I provide the most weight to relative to my trade? And as I'm planning a trade, I am always working from the outside in, longer term to short term. I am giving more weight to the shorter term levels, because that's the most recent levels in interest by buyers and sellers, with consideration and reference to longer term. That's why when I have agreement or confluence between the longer term volume profile and a shorter term volume profile, I know I have a really good level. But I always give more weight to the shorter term, meaning the most current. And when I'm into a trade, that's why I watch the print, I give the most weight to what the current buyers and sellers are doing, because they are the ones who are going to take me to profit or into loss. So I want to make that really clear. I give the most weight in terms of my trade decision, trade management, to the most current volume profile. So that may be, you know, I'm going to show you as we learn to plan trades and learn to identify the day and how to create trade plans on the fly during a day. I'm going to show you how to take the previous day's activities and then start identifying what the current participants are doing, and then building or changing, confirming your trade plan as the day goes on. And again, we're going to go through this a lot of times. Can I define unfair high and low? Jim, yes, I'm going to do that today, and you're going to see that in a presentation today. And as we go through the market structure, the volume profile structure, I want you to hold that question, because if I don't answer that question after I do the presentation on the 7 elements and the attributes of the volume profile, if I don't answer that question, I want you to ask me again, okay? Is that fair? Okay. All right. Thank you. All right. The short-term volume profile, effective for Globex and cash market trading, can be used to profile a specific historic rotation or a profile within a range of days. So here we are in the ES. We're at all-time highs. Someday, something's going to happen. Responsive sellers are going to step in, and this market is going to start to move lower. And we are going to want to make sure that we're able to utilize data from the history of the ES not to trade against, but to identify potential levels. Doesn't mean that once you identify a level that has historic relevance, it doesn't mean that it's going to be the trade that you want. It's a reference point. And once the market confirms that level, then you have a much stronger potential for a trade. And again, we're going to go through this a lot of times, so don't feel like you need to get all of this right now. But you can use a profile. You can build a profile for any specific time in history in order to see what happened and what the profile, the volume profile, looks like. Where are unfair and fair prices? So the other volume tools that I talked about yesterday and I want to present is just a simple, very, very simple 1-minute volume chart. I'm going to show you why I want to do this. Now, I'm using a very small probe and rotation. And I'm going to create another volume profile. That's our today, this volume profile does not look finished to the downside, I can tell you that. This looks like it has more room to the downside. And don't worry, I'm going to show you what that means. But I'm using a very tight probe and rotation, 6-4, right there, very, very tight on this chart. And as you can see, as this moved down towards the end of the day yesterday, we went from 36 in terms of this probe down to 28.25. And so with the probe and rotation, in all of this volume, it may be difficult, and here's the volume clusters and the tool that we use to identify where that volume came in. But throughout the day, I want to be able to see, I want the sensitivity of the 6-4 probe and rotation, but I want to understand if and when price is moving based on a big move of volume. This thing is not done. Sorry, I'm a trader first, and once I get a chart up, it's all over. I just love to trade. So anyway, so I use this very simple 1-minute chart, and this is simply what it is. It's a ES, it's 1 minute, and all I am looking for, I typically put a little blue line. It's just so easy to do. I put a blue line around 10,000 because 10,000, this is news coming up here. This is any volume spike during the RTH session that I get up at 10,000 or above, and this was almost 30,000 this minute, that causes me to move over to the print, check out the volume cluster analysis, and start watching what happened. So in this example, here's a low volume area right here at 22.75. I can see in the volume cluster we had a neutral auction in this bar, selling coming in, and I can see the selling starting to get real heavy. But the other thing that I see in this market, look at the buy side or the offer side on this. Relative weakness in terms of colors, but look at the numbers. I mean, this 254, 704, 78, 813. It wasn't just that the buyers were weak. They were non-existent. Buyers were non-existent. So all of the volume that came in at this time was volume that came in at the bid. The majority of that volume spike came in at the bid. I can confirm that up here in the volume cluster, but that tool, right, if I'm going through the day, you get into the doldrums of the afternoon and so forth, and all of a sudden you get a volume spike and price moves. The reason I use the 1-minute chart is it's a really small time frame. And so it does a really good job of flagging these areas. The other place that it becomes very handy for me is in the overnight, and especially the pre-market. So I'll start looking at these little 1-minute outliers, and I just use it as a flag. I look at the time, and I go back into the print, And these are the places, when I use the print as a process for understanding context, then these tell me where to go look at the print, look at the volume cluster analysis at this time, and here, and here, and here, and start seeing what happened in the print and what the buyers and sellers were trying to do. So all of this is, for me, is a warning, kind of a sign. Here's one. If I were trading the Globex market or trading the Euro session, right? We get the open at the Euro session. I would start looking at these volume spikes as in the print as reference points for me to understand context. So that's all I use it for. It's just a flag, because 1 minute is not a lot of time. And typically, if buyers and sellers are going to overrun an area, they're going to do it with a lot of volume, and they're going to do it in a very short amount of time. So the 1 minute chart for me, with that, I don't really care about buy or sell volume. I just care about the volume overall. That gives me a really good heads up to go at that point and check out the print. The other thing it does for me, as I'm looking at the day, beginning of the day, I sit down to my computer and I'm starting to look what happened in the overnight. It's one thing to look at a volume profile in the overnight. It's yet another thing to go back and look at that 1 minute chart and say, it tells me very quickly, where did a lot of volume come in. I go over to my structure chart and my order flow chart. I look at the volume cluster. I get confirmation of the type of volume, and then I start watching to see what it did to price. How effective, remember that's the second part of the question, how effective are those participants in doing what they're trying to do? So if I can see, using the print, the structure chart, that volume's coming in at the bid, meaning what would be considered sellers, I can see what it does to price. And if it does nothing to price, that gives me information. If there's another spike, they try to move it lower, it gives me information. It starts telling me there's likely stops down below, buyers are holding. This is an area I want to start identifying as a potential trade long. So 1 minute volume chart, it shows volume spikes in a relative small time frame. It acts as just a call out to reference the order flow and structure charts. I want to be real clear. I'm not using that chart to trade. I'm using that chart as just a call out. I also use a 2500 tick chart for open and closing swings. And here's the reason again. Our closing swing yesterday, let me go back here. The closing swing for yesterday was 1931.75 to 1933.75. And what I've told you is a lot of times these closing swings will have relative meaning in the Globex, in the overnight session. Now, again, I've got a pretty sensitive probe and rotation chart, right, 6-4. But that the move down at the end of the day was all probe. There was no rotation until after the market closed, and we were down to 28.25. So even with a tight probe and rotation, if the market keeps probing without the rotation, then I'm likely going to miss that move. And you can see in the overnight, right, price started moving back up, and it hit the closing swing low, went weak at the offer, and from this point, 31.75, move 4 points. Move 4 points off of this level. Tried to come back up, and in the European session, couldn't get through opening swing high or closing swing high, started failing, and once it failed at closing swing low, it became a 31 to about a 9-point trade. Closing swing is the last push by buyers and sellers in the ES, in the market. And it's this again is a fairly simple chart. Again, my system is a little bit slow here. Let me bring it over and show it to you. Now let me show you the opening swing for today, right? Because I use this for opening swing and closing swing. We're going to go through this again, not to worry. When we start looking at actual trade plans, we're going to go through this again. So this is a super simple, just 2,500 tick chart. And the only reason I use this, is to identify opening and closing swings. Because we're going to go through this, but most of the volume in any auction comes at the beginning of the auction and at the end of the auction. Even if take eBay, for example, right? An auction opens and there's a whole bunch of bids and it bids itself up. Then the volume comes down. Let's say there's a week long in the bid in the auction. There's an initial push to some level of value with more volume, and then it just kind of sits there, maybe a few more bids here and there. And then right at the end of the auction, there's a whole bunch more volume and a whole bunch more bids. I mean, that typically is what an auction is. When there's an open, when there's a close is when you get the most volume, which is why I use a 2,500 tick chart. And the open for today is right on yesterday's open. It was 25.50. So I go back to 8:30 at our open. I'm sorry, it wasn't as yesterday. Here, 25.50 was the open. And now all I'm doing is looking for the first push higher, which is right there. And I'm looking for the first response push lower, which is right down here. And that simply right there becomes my opening swing for the day. That's it. There's my open. There's my first push by buyers. There's my first push by sellers. And what you will find, not necessarily today, but what you will find, for example, when price broke above opening swing high, it stopped back at opening swing high and moved higher. You can see it came through, back down opening swing high, couldn't get back through opening swing high except for a couple of ticks, and then moved lower. Once it broke through opening swing low, the likelihood, and this was at news, but the likelihood was that it was going to keep exploring and probing lower. And you can see it's having some issue around opening swing low right now, but it looks like this is going to make some progress. So these just become levels and levels after the open that I pay attention to. So as price is moving up, and somebody asked me this question yesterday, how much weight do I put into the open? You know, I'll watch the open right now, but it's already proven to just, price is just passing through the open. It doesn't seem to have any relative importance, at least at this point. So price has moved up, and I'm not even looking at the print, I'm just looking at this. And so what I would be looking for is a potential long, and all I'm using is a 2,500 chart, is a potential long off of this level. Of course, I'd go back to the print, make sure that the print confirmed that, in fact, sellers were walking away, buyers were stepping back in. And if that were the case, then I would look for price to move up and low, and back up to open, and possibly up through opening swing high. So that is it. That is all. It's the only time I use that chart because even with a probe and rotation, I might not get that initial push. It's a tick chart. It's not a volume chart. It's a tick chart. It's a 2,500. Oh, you know what? It might be. It's supposed to be you are correct. 2,500. Let me go back here a little bit. You are correct. That was, let me go back here, hang on a second. It's kind of the same thing. Here's the open. Here's the first push by buyers. It's a good clarification though. First push by sellers. You can use a 25. Hang on a second. Changing things on the fly here. Sorry about the delay. Yeah, I would 2500 tick chart. Here's the opening swing high, opening swing low. It kind of shows the same thing, but just for clarification, make this a make that a 2500 volume chart for opening swing high and low. Thanks for the clarification. Yes, I plot those manually, opening swing high and low, because it changes every day. Does it matter? Yeah, John, just make it a 2500 volume chart. 2500 volume chart, just to clarify. So why is this open swing high, closing swing high or low important? It's important because in an auction, it is a series of push and pull, right? There is this effort by buyers to push price higher. There's this effort by sellers to push price lower. And from the open of the market, I want to understand what is the result of that push. What's the result of the first push by buyers? What's the result of the first push by sellers? It's my first indication of the day and my last indication of the day of the buyers and sellers sentiment, where their conviction levels are to. Does that make sense? So all it is a reference point for me, and I'm using it only as a reference. And I think I've shown you in the last 2 days the value of the closing swing. I'm telling you, in the Globex market, the closing swing high and low often acts as a great reference point for trade opportunities in the overnight. Doesn't mean that they will always work. That's why you always have to go back to the print and use the print as your trade entry and trade management tool, which is why we start reading the print, using it as a trade management, trade entry tool. So those are the only other, this is tick, I'm going to change that to volume, a 2500 volume chart for opening and closing swings. And I'm going to show you closing swings, so don't worry about that. We're going to go through that again. It is, again, the most volume in any auction is at the start and at the end. And the other thing, this 2500 volume chart, not tick chart again, thanks for the clarification, it's for the S&P 500 E-mini. Now, you know, if you try to do a 2500 volume chart on oil, you're going to get, or the TF, you're going to get a swing that, you know, takes the first 10 minutes of trade. It's going to take a long time. The 2500 is just for the ES because it has so much volume. But historically, it's been an excellent setting, the 2500 volume chart, to identify those opening and closing swings. So I don't want to spend too much in the morning here on this because it's all those two charts are. The minute chart is just sets a flag for me. It says go look at the print here. The 2500 chart, all it does is say here's the first push, here's the last push by buyers and sellers. Flag it, identify it. If there's any confluence around it relative to how the day progresses, then potentially use it, but I'm just identifying it. So other volume tools is order flow and structure chart. Everybody has been through that. We're looking for aggressive buyers and sellers. The order flow confirms trade opportunities. The structure chart shows us structure in the different bars. Can show a finish to an auction in a specific direction with order flow. If we see, for example, prices moving down and we can see sellers backing off, buyers coming back in, it can help support what we look at in the volume profile as a potential finish to one side of the auction. And it can also show in the order flow, we can see held bids and offers. So we can see volume coming in, let's say prices moving lower, we can see more volume coming in, we can see activity at the bid building. They're hitting the bid, they're hitting the bid, hitting the bid, and they keep hitting the bid. A lot of pressure at the bid. The offer may not even be that strong at that point. We just see the bid growing, but price is not moving. And so our immediate reaction is right now, and that's always your thought is right now. You don't know what's going to happen in the next minute. Right now, buyers are holding the bid. If buyers are holding the bid, what do I need to see to take advantage of this? What do I need to see in the print to take advantage of this? Well, I need to see strength coming back in at the offer, just above where buyers are holding the bid, and I need to see weakness at the bid as strength comes back into the offer for me to take a long. Otherwise, the sellers may just get to a point of overwhelming the buyers. If I try to go long before the print confirms it, I'll get washed out of the trade. So the order flow can show us held bids and offers. You know, people can talk about iceberg orders and all of those things, and I've seen indicators out there, and I'm not here to say that they're good or bad or indifferent. You know, iceberg order indicators. What I would tell you is don't rely on an indicator. If you see a held bid or a held offer, all it tells you is right now buyers or sellers are holding this level. I'm looking for this to give me a potential trade. If I don't see this in the bid, I don't have a trade, because when this much volume comes into the market and we're getting this much pressure either at the bid or the offer, anything can happen. So I'm going to sit on my hands. I'm going to wait until I see these things happen, and then I'll make a decision on a trade. Roberto, to answer your question, those two charts adds to context. Absolutely. Thank you for saying that. I could not have said it better. It adds to my context. It is just another piece of the story for me, right? So when I talk about reading the order flow as a process, what I'm doing is I'm building a story. I'm building a story about the market participants that says, here's where their fair prices are. This is where I see volume and they like to trade. Here's where they seem to get active. Buyers get active. Here's where sellers seem to get active. And so I'm building a story. And that story helps me to develop a trade plan, a developing trade plan as the day is developing. And that's what context is to me. It's the story of the market. And that story is a story over the current day from the open. It's the story of the overnight trading. It's a story of the combination of them together. And again, what I wish I could tell you is that there was some easy way of taking all of this data and telling and being able to create just a quick summary that says, all right, here's what the market's trying to do. Here are levels, and we can get to levels pretty easily. But to be able to identify when change is occurring in the market, when buyers and sellers are changing sentiment, when you can do that by building your story, at that point, you can start to move around into different instruments and understand the nuances of that instrument, but you can start building the story in those other instruments and becoming an incredibly effective trader in other instruments as well, and other trading methods as well. So that's a perfect response, Roberto. It adds context. That's perfect. Does the opening swing low have to be below the open? That's a great question, Dirk. You know, if we have what's called an open drive is an open type, and we're going to talk a little bit about that over the next couple of days. But an open drive is an open type, and it was one of the things from yesterday that I talked about that is a remnant of market profile that still has value to us as traders. So understanding an open type, like an open drive. So if price opens and there is no successful trades at the offer below the open, and price just moves up and starts creating distributions higher, then the open becomes the opening swing low. And then I give the open a little bit more weight as price, and if price moves back down to it. So great question. Does that answer that question? It doesn't have to be below the opening. It's very rare that it isn't. but it doesn't have to be. Okay, awesome. Okay. So these are just with order flow and structure chart, different things that they can do. Let's talk a little bit about, we're moving on to about an hour, a little over an hour here. Purpose of the volume profile. The primary purpose of the volume profile is several purposes, is to provide an accurate display of the market participant activity in the form of a profile, and also to provide context of market participants' price, interest, and non-interest, meaning basically where are fair and unfair prices. But it can also provide identification when an auction might be coming to an end. I'm going to show this to you today, and it will be fun for you to see this. Areas of opportunities for entries, and scale and target areas. So if I can see a low volume area, low volume typically means an unfair low or an unfair high. Let's say price is coming up to an unfair high, a low volume area. We see seller step away, buyer step away, seller step in, and the market starts moving back down. The scale or the target is going to be back at that high volume area or VPOC, because that's fair price. And it's most likely that price is at least going to fair price. I'm going to show that to you today. Some of the benefits of the volume profile: you're able to see what prices buyers and sellers consider to be fair and unfair, especially over time. The other one is it's incredibly visual. It allows for very quick identification of key levels, and it can adapt to all types of market conditions and different volume levels. So again, we talked about on the TF, on the CL, on the ES, the YM, all of the volume is relative to that instrument, that specific instrument, and therefore it becomes able to adapt to that certain or specific instrument. It will identify areas of opportunities for long and short trades, and it provides excellent scale and exit points for managing trades. Why is it unique? Well, it's not really an indicator. It's a historic framework for market participant activity, showing where they are likely to trade more and less volume. We're going to talk specifically today why a low volume area is an opportunity for trading, why a high volume area is an opportunity for a target. The volume profile provides low risk, high reward. One of the things, we're risk manager first, high reward trade opportunities more consistently than any indicator does, and it also provides and shows you the opportunity well before the trade actually occurs. And like the print, it does not lie. It is made up of the order flow. It is made up of only actual contracts, stocks, whatever the vehicle, only made up of actual order execution. So it is truth. Just like the print, the order flow, it does not lie. So this is why yesterday when I talked about the fact that you can have high frequency trading, you can have dark pools, you can have all of these types of entities, institutional buying and selling, all of these things happening. But at the end of the day, they all get represented in the volume profile. So it shows all of their interests, not it doesn't exclude any one participant, which is why over time the volume profile adds more credibility or has more credibility in the levels. And again, it shows market sentiment regardless of who's trading. Computers, algorithms, doesn't matter. Locals, individuals, doesn't matter. I think it's important to understand what the volume profile is not. It's not a predictor of price in any direction at any given time. Unless you're sitting on $50 billion in your account, there is nothing that is a predictor of price direction at any given time. There's no indicator, there's no setting, there's nothing that can literally predict price. What we can do is see the structure and the framework and identify, as we build the story, identify areas of interests both for an entry and for targets within the market. And then again, we always go back to the print to confirm that what we expect to happen is actually happening. but nothing is a predictor of price. If anybody ever tells you anything is a predictor of price, just run very fast. It's not a technical indicator, right? So it's not calculating certain combinations of volume over time, over price. It's not a technical indicator. It is simply a representation of the activity, the executed activity over a specific period of time for a specific instrument. The other thing is it's not really widely used. I would tell you that those who learn how to use it as an additional tool in their trading find significant advantage to those who really don't know how to use it. So those who learn have a significant advantage because it provides additional context. It's also not a trade confirmation tool. That's why we go back to the print. The print is our trade confirmation tool. Remember, the moment of truth, when we hit the button in our trade, what we care about more than anything is what the current buyers and sellers are doing, specifically doing to our trade. You know, like I said yesterday, our trades are like a leaf in the river. But if we want our river to go north and the river's running south, you better get a net and get that leaf pretty quick. Otherwise, it's going to take off south on you. So the print is the trade confirmation tool. It tells you what is happening between buyers and sellers at that moment of truth. It's also not time dependent. Though we do look at volume across time or rotations and in specific sessions. So I'll look at a volume profile for the RTH session. I'll look at a volume profile for a Globex or evening trading hour session. I'll also look at a volume profile on a Globex session across Globex session. It's not time dependent. What I care more about in a volume profile is making sure that I have the data that represents the push higher and the sentiment by buyers and the push lower and the sentiment by sellers. I care more about that than I do about the time. All right, let's talk a little bit about elements and attributes. And to do that, I am going to go to a new this is about an hour and 20 minutes into it. I'm going to bring up a new presentation. Would you guys be okay with taking a quick break? 5 to 10 minute break? You're good? Okay, let's do that. We will resume at 10:30 Eastern. Awesome. Perfect time for a break. People are here, ready to go. All right, so we'll go ahead and get started with this next piece of the presentation on volume profile. And again, we'll get back to the charts for today. And once we're through this, we're actually going to be able to start applying what we've gone through today relative to today's activity. And in fact, the other thing I'll show you today is a volume profile chart in oil as well, just to kind of show you how the elements and the attributes work across different instruments effectively. All right, so I had a feeling this was going to break higher. Now I will tell you this, if on the ES, so you watch this, if price gets through 28.75, I'm expecting a move back up towards closing swing high 31.75 to 32. That area, if it gets through 28.75, and it does not look finished to the upside. So if you're watching the ES at all, that would be my my call, my expectation. All right, I am going to go ahead and get into this presentation. So we're going to talk through the volume profile elements and the fundamentals or the attributes of those elements. And a couple of things I want to talk to is, I got here that the volume profile can be a pretty good target. I mean, we can really start getting pretty precise with some of our levels, and you're going to be able to see that here coming up. But there is one key thing about the volume profile, and this is why when I talk about it being effective and being useful in every market or every instrument across different time frames, is because it doesn't matter what instrument you use the volume profile in. It doesn't matter what time frame, what session, if you're going across 7 years or 7 days. The volume profile, every volume profile has 7 elements that are exactly the same. Doesn't matter. Doesn't matter. They're all the same. So this is why we focus on these fundamentals. When you're able to understand these elements and the attributes, meaning how price responds and how participants respond to those elements of the profile, what they mean in the market in terms of price and price movement. When you start to understand these fundamentals, that's when you're able to start taking the volume profile and effectively using it with the specific nuances of, say, an oil chart or a gold chart or YM or bonds or whatever it might be, as long as it has volume. But there are 7 elements, and we're going to go through those 7 elements. The first one is volume profile or volume bars at price. What do I mean volume bars at price? Every single one of these bars is created as contracts are traded at the bid or the offer. Anytime there's an actual execution, an actual print, it simply gets added to that price. So if there's a print at a price, it gets added. So again, every transaction at each price is recorded and represented as a single volume line. The more transactions, this is really simple, the more transactions, the longer the line, the fewer transactions, the shorter the line. And that is going to give us the profile. You stack all those together and you have a profile. It doesn't care if the contract was traded at the bid, and it doesn't care if it was traded at the offer. All it cares is that there was a print, a contract executed at that price. It cares about total volume, not whether it was at the bid or the offer. So the next element, so the first element was each one of these individual, at each price, we collect volume, or the system collects volume. And it says at this price, this many contracts were traded, and here's the bar representing that. At this price, more contracts were traded, and here's the bar representing that. And so the next area, or the next element that I want to talk to, is this thing called the high volume area. And that would be right here, the high volume area. And a high volume area, we're going to go through the attributes of that, is represented by the peak of this distribution being this bell-shaped curve. And that's actually the next attribute I want to talk to is in the high volume area, you'll see low volume areas to each side. This represents a price distribution. And what we're going to talk through is as price is auctioning. So when we start talking about, okay, how does the volume profile relate to this thing called order flow? Well, when you understand what order flow is, you kind of break all this down. You understand order flow, like we talked about yesterday, is buyers and sellers exchanging contracts at the bid and the offer, right? They're exchanging contracts, bid, offer, price moves up, price moves down, price moves up, price moves down, and we get balance to imbalance. But as that progresses, and that could be progresses or develops throughout the day, as that progresses throughout the day, or over a week or a month or a year or several years, it starts to build out what's called a distribution. And that distribution will typically give us, it will naturally result in this bell-shaped curve. And the reason is because we have fair price in the middle, and towards the end, we have less fair price or unfair prices. And it's the same scenario where hey, I believe I can make money. If I'm short or long, I can make money right here. It's a fair price. I can make money. Down here, not really. So think about it. Let's say, for your own example, let's say price on the ES goes 20 points, right? You're in a trend day and it goes 20 points. 20 points to the downside. What's your thought? As a trader, you're thinking, man, this can't go on forever. Even if I get in short, how much more can I really make? Right? So as price moves lower and lower and lower, as a trader, you go, my goodness, it's already moved so far. How much more can I really make? As it moves up, except in a market that is somewhat artificially inflated, that's another time. But typically, buyers will say, okay, price has moved up, time for me to take profit. Time for me to take profit, or participants say, what? I can't make any more money. I can give you a really quick example to show this as well. And the example I like to use with people is that of Super Bowl tickets. So let's say that I'm going to auction off, I'm going to invite 100 people to an auction. I'm going to auction off Super Bowl tickets, and I'm going to give away 2 tickets, 50-yard line, 15 rows up. I'm going to pay for airfare. You're going to get on-field passes, after the game parties, room board, etc. Great package. And I'm going to invite 100 people who I know want to go to the Super Bowl. And I'm going to start the auction at $500. Now, how many people of those 100 do you think are going to bid if the price is $500? You can answer that question. How many people? I've invited 100. I got 100 people in a room. All of them. 500 bucks? It's a great deal, right? Fantastic deal. Now I'm going to start raising that price. I'm going to go to 1,000. I'm going to go to 1,200, 1,500, 2,000. There's going to come a number when that number is going to move from 100 to 99 or 98, right? It may be $5,000. It may be 10. But there's going to come a number when that number moves lower. And once a couple start moving away, we'll move price higher, because that's what an auction does. Price moves higher, and maybe at 6,000, 7,000, people start thinking, well, you know what? I like my Super Bowl parties. I'm not going to do this anymore. And as price moves up, what happens to the number of people involved in the auction? Does it go up or down? It thins out. Exactly, John. Exactly. It thins out. And it will continue to thin out, because as price moves higher, the relative value of that price is not as strong as it was lower, because in the case of an auction of a market, fewer people believe that they can make any more money. So they start stepping away from the auction, and volume starts thinning out. It's one of the signs that an auction may be finishing to one side. And in this case, it's just a single direction auction with price moving up, and eventually we'll get to a point where there are 2 bidders left, and the final bidder will step away, or one of the 2 bidders will step away, and the person will win the auction. But that may not be until price gets up to $75,000. I don't know what the number is, but it may not be. And the point of that is, it doesn't matter, and our current ES market is a perfect example. As it's been moving higher and higher into all-time highs, the overall volume of new contracts coming in isn't rising with it. It's not like there's a lot of new volume coming into the market. In the example of the Super Bowl tickets, it shows you that fewer participants can still take price higher and higher as long as they see value. But let me ask you now, when that last bidder wins, and the auction is over, where do 99% of those participants believe value is? Lower, right? They believe it's lower. Now, if you're one of those participants and we have a bidirectional auction, and you can initiate a sell at $75,000 or $70,000 for a Super Bowl ticket, you're likely to do that. You're likely to want to do that. And that's how our auction works. As price moves higher, we get less participation, and so it begins to thin out. As price moves lower, we get less participation in sellers because they don't believe that they can make as much money, and that starts to thin out. It gives us this curve, this bell-shaped curve that we're looking at here. So I call it the price distribution curve, right? And so in that we have fair price, which is a high volume area, and we have an unfair price, which is a low volume area. At our high volume areas, we have a lot of participants. They're all jumping around, they're all excited because they're making money. It's a price where they believe that they can make money. They believe that whether they're entering short or long, it's a price that where price will move enough where they can make profit. So fair price attracts a lot of activity, attracts a lot of participants. Whereas a low volume area, you have fewer participants, and as price, let me put it this way, price moves down, down, down. What are you thinking as a trader? What are you automatically thinking? Well, this can't go down forever. What goes down must come up, right? And so you're looking at potential areas to get long again because you know that price is going to move in a specific direction until the other side steps in to shut that movement off. When the other side steps in to shut that movement off, if you get in at the bottom, you got a great trade, right? So the volume profile shows us areas over time, and meaning even within a day, across weeks, months, years, where participants believe price is either fair or unfair. And it results in volume profiles that have these successive volume distribution. Part of that volume distribution are these high volume areas. High volume areas have a lot of activity. They are fair price for both buyers and sellers. And we get rotation. Because buyers and sellers are active at these areas, right? You do it too as a trader. You get in, when you buy, what do you automatically become when you buy? When you have a contract to buy, you automatically become what? A seller, exactly. You automatically become a seller, right? And so price starts moving up, you look at your profit, and you say, hey, I have some profit. I'm going to sell. Maybe you've got a couple of contracts on, maybe it's 5, maybe it's 10, who knows? But you're going to start taking profit. And you're going to start taking profit. As price moves up, there are going to be more and more people less willing to buy, and price will start moving back down and rotating back down because you're a seller, and if other buyers bought where you are, they're selling as well. That selling is going to cause price to rotate back, and we're going to see more and more activity at these high volume areas. And these high volume areas, because they're considered to be fair price, become price magnets. So remember, at each extreme, we have these low volume areas, unfair highs, unfair lows. And in the middle, we have these fair prices. So when the market says price is moving down, 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 down towards a low volume area, and sellers finally say, okay, we're out. And buyers say, wow, price is really low. This is a great deal. This is a great deal, I'm buying because value is higher. Guess where price is going to go? Prices, well, most likely, the most likely scenario is for price to move back to that high volume area. So high volume areas become price magnets. So it's one of the attributes of the element of a high volume area. Rotation, fair price, and it acts as a price magnet. The next element in the volume profile are these low volume areas. Now, low volume areas are really interesting because they can do one of two things. They're unfair highs and unfair lows. And a low volume area can be both. We're going to go through this, but it can be both an unfair high and an unfair low. And I'm going to show this to you and how understanding the different price distributions will help you identify targets for your trades. So, again, unfair highs, unfair lows at the low volume areas. And what that means is one of two things is going to happen. Because there's not a lot of volume there, typically what we see is price action, and most times rather rapid price action. And so what happens is price gets to this point and it either hits a brick wall. Let's say price is moving up, it hits an unfair high. It's too high for the market, too high. Step away, seller starts stepping in, price starts coming back down, it moves back down to fair price. It acts as a brick wall. Or price moves up, 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 comes to a low volume area, an unfair high, and buyers keep pounding, lifting the offer, lifting the offer, lifting the offer. They just keep pushing pressure, pressure, pressure. And eventually, what they need to do is throw a ton of volume at the low volume area to get price through, and it comes smashing through that low volume area. And now that level that was an unfair high, now that price is above it, is now an unfair low. And it's going to be a place where you're going to see momentum dots. You're going to see volume cluster analysis, a VCA mark there. You're going to see in the 1 minute chart, when price comes through a low volume area, the 1 minute chart, you're going to see a volume spike. Almost all the time, you're going to see a volume spike as price comes through a low volume area. Because it takes, in terms of the auction, it just takes extra volume to get, remember, we're at an unfair high. Unfair high, sellers are going, man, this is a great price. Value is lower. And so you have more sellers willing to sell. And to get them out of the way, it takes buyers an extra amount of volume needed in terms of contracts at the bid or at the offer to get those sellers out of the way and push price back up through that. They've taken out those sellers, and you've seen this a lot of times. Price comes back to that level, and then it just takes off from there. They get them out, they sell a little bit, and then they buy back at that level. It's why you've heard the statement before that, you know, resistance becomes support, support becomes resistance. It's not just a saying. There's a mechanical reason in the auction of what's happening between buyers and sellers that makes that oftentimes a very true statement. It's not just a saying. And when you understand what's happening behind the scenes in the auction, now you can start using your auction tools, your OFA tools, to identify, okay, I got a low volume area. This is looking like a brick wall. I can see prices come up. I can see, even though buyers are pushing, I can see sellers holding. I'm going to take this trade, and maybe my stop is 3 ticks. And it starts moving away. It starts moving back down, and you take your first scale 1 or 2 ticks out in front of the high volume area of that distribution. Again, I'm going to show you what that looks like. So low volume areas either act as brick walls, or they act as slingshots where price comes smashing through that level. Another element of the volume profile is this thing called VPOC, or volume point of control. It is the single highest point of volume in the profile. So if you're looking at a 3-month profile, doesn't matter, 1-day profile, every volume profile is going to have a point where there is the most volume. And that's going to be volume point of control. And it's very similar to a high volume area. It's the highest volume area for any given time frame. And it's kind of like home for price. When price fails higher, it moves back to VPOC. Typically, it doesn't always have to be that way. But when price fails lower, again, it typically will return. When sales when sellers fail to push price through a low volume area to the downside, and they get stopped out to the upside, they're usually going to wait until another price. They're not just going to, typically, they're not going to re-engage and try to, take out these buyers who just took them out, right? They're not going to re-engage. If you're a seller and you just got stopped out by buyers, what's your first thought? Well, if I'm going to sell again, I'm going to find an area above to sell, right? That's your thought, because value for a seller is going to be higher once they get stopped out. So the volume point of control, once that happens, is the most likely place where sellers would begin to re-engage because it's a fair price. So sellers start to believe that they can make money at VPOC. They've proven it. So it becomes home. Fair price, I told you, it acts as like a price magnet. And it's why in a volume profile, the high volume areas or VPOC act as phenomenal targets. Remember yesterday when I was looking at the ES, and maybe you don't remember, but 23.50 was the VPOC, and price had just moved up beyond a low volume area. And I said, this would be a long, and I said my first target would be 23.50. And I actually said at that point I was looking for 32, at least 32 on the day, because of the way the auction didn't finish last Friday. We got the 23.50 and the 32 and beyond. But all of that was because I understand that if sellers are failing to the downside and they get taken out, I can see them pushing, they get taken out. They are likely not going to re-engage until at least someplace they consider to be fair price. And that first place is going to be volume point of control for a specific price distribution. Does that make sense? What's important for me in all of this is that you start to understand relative to the auction what happens behind the scenes. So again, when you hear things like, well, support becomes resistance, resistance becomes support, you understand what's really happening between buyers and sellers, and it's something that you can see as evidence in the print. Because sometimes what will happen around a low volume area, especially on the ES, and especially in the last year and a half, maybe a little longer, on the ES, sellers have typically been nothing more than contributors to buyers. So what I saw, in fact, 2013 was a tough year at the beginning of the year, around March and on through the rest of the year, as we really started moving higher in the ES. Because what would happen is there would be a low volume area that was established to the upside. Price would come up, and I would see the opportunity. The print would give me a signal, right? I would see weakness at the offer, strength coming in at the bid, and normally in a market you get some level of rotation, you get some level of pullback, just because participants are managing their inventory that way. And what would invariably happen is I would get into the trade and sit there and watch the print, and I could see the activity coming in at the bid. I would get a couple, 1, 2, 3 ticks, and that was it. Buyers were holding the bid up at the low volume area, at the high of the low volume area, and then they would push through with this incredible amount of volume to take the stop, grab the stop, and then price would come right back down, and my trade would have worked. And I can't even tell you, at the beginning of 2013, when you expect rotation, you don't get that rotation. I don't think I've ever seen more stop runs in my life as I saw in 2013 and through the first half of 2014. And what we're going to do in this course is identify in the volume profile and in the print, if you're in a trade, you've taken an opportunity for a short or a long at a low volume area, what you can never do is know if you're going to get stopped. If you're long, you are never going to know if there's going to be a big push by sellers just to go grab those stops. Could happen, could not happen. It can't keep you from your trades, right? You still need to take your trades, but we're going to identify things in the print that are, and we've already talked about a few of them, that are automatically going to tell you, oh, this is at risk, I need to do something. Or I just need to simply understand that my loss is going to be these 4 ticks or 5 ticks. And the great thing about this is I'm going to show you using the volume profile and the print what is a stop run. And I don't mean just using the stop run analysis. I want to show you in the print what does a stop run look like. Where is it most likely to happen? And it's most likely to happen around a low volume area. And what does it look like in the volume profile and in the print? Because once you get a stop run, let's say you're looking to go long and they sell into in towards your stop and they buy back and take price back above that low volume area in a hurry, I want you to be able to get back into the trade because the level is still likely a good level, but you can't avoid those stop runs. And you can't move your stops thinking that, well, this might be a stop run, this might be a stop run. So the other thing we're going to do is identify what does the stop run look like in the print and in the volume profile so that you can effectively get back into a trade if that's what happens to you. But also, when is a move through a low volume area likely to be an ongoing move? When are we likely to get continuation? It's a real move. What are the things associated with that move through a low volume area that tells me this is a legitimate move and I either have a short or a long opportunity? A couple quick questions here. Do I follow RTH profile or Globex or both? I follow, when I'm trading the ES, I will typically start a new profile at the beginning of the session at 9:30 Eastern. I use the Globex profile as a reference point similar to opening and closing swings. I'll use it as a reference point. So in the overnight, in the Globex session, I will get low volume areas and high volume areas. One of the things that I do, especially with the opening swing, if it's within range, and it is within the Globex, I am looking to see if an opening swing high, let's say it opens lower, the ES opens lower. I'm looking to see if the initial push on a move higher in the ES, for example, if the opening swing lines up with a Globex low volume area. If so, then I have some additional confluence that that's a key level. And it starts helping me build my story, which is the context of the market. So I do use both of them. And once I kind of get into, once the day starts progressing and the RTH session shows that the Globex sentiment is not valid, I really don't pay any attention to the Globex anymore because I know that in the RTH session, 80 to 85% of the overall volume comes in, and it's likely just going to run over anything that was there in the previous Globex session. So would I consider the high and low value areas unfair price? I would consider not necessarily value areas, right? And we're going to talk to value areas here in a bit. Not necessarily value areas. We can get action off of high and low value areas, but I don't necessarily consider them to be fair price. And we'll go through value here coming up. In fact, here we are to value area. I can see my presentation is a little slower than what's on my screen. So, so the next element of the volume profile, and so far we've talked about volume bars at price. We've talked about price distribution, that bell-shaped curve. We've talked about the high volume areas, low volume area, and volume point of control. The next one is the value area. And the value area is pretty simple. It's a function of VPOC, always a function of VPOC, volume point of control. and represents one standard deviation, or 68.2 to 70% of the most volume from the VPOC. So it's easy to understand how it's calculated. Volume point of control represents the most volume, most price, most volume at that price. And then it simply takes, finds the next area or price that has the most volume, and above and below, and 68.2 or 70% of the overall range. It identifies the 70% from volume point of control that represents the highest volume bars. That becomes value. And the thought behind value, just so you understand, and this is way old school, but the thought behind value and the 70% is that in any given time, in a total range of a market over a specific period of time, it is likely that 70%, if 70% of all transactions happen in this range, then the market considers that the value of that range for that time. So it's a function of VPOC, and it's, let's just say 70%. 70% of the highest volume bars from VPOC. So sometimes you'll see VPOC towards the bottom of the value area. Sometimes you'll see it at the top of the value area, and sometimes you'll see it in the middle of a value area. And given where VPOC is relative to value range, it tells you something. So if VPOC is at the top of value, it tells you that above VPOC, there wasn't a whole lot of interest. And the majority of the interest for prices was below VPOC down to value. So that tells you that that market is somewhat bearish for that day or that time frame. If, however, VPOC is at the bottom and most of the value area is above VPOC, then that tells you that that market is relatively bullish because the majority of volume occurred above most fair price. And that may take a little bit to make some sense, and you're going to have to see that a couple of different ways. But based on where VPOC is relative to value, it starts adding to the story. All of this information I'm giving you adds to our story of answering the two questions. What is this market trying to do, and how good of a job is it in doing? How successful is it doing its job? By the way, on the ES, I know it's come down. I'm still looking for that 31.75, 32 level today. Anyway, so that's value. And I'll show you why I'm looking for it specifically. In fact, when we get into a couple of slides here, and I gotta move it along. When we get into a couple of slides here on the different structure types of the volume profile, I'm going to show you the structure of the volume profile from yesterday and why I am specifically looking for 30, 31.75, 32 today. All right. So the next one, the last one, is this thing called the finish. Remember the example I gave you of the Super Bowl tickets and how when price starts moving up, there are less and less participants? Well, the volume profile, like I said, is very visual. And on every volume profile, what I'm going to show you is how the market finishes in the volume profile. And what it is it's not always the final end of an auction, but it's an end of the auction for that point in time. It's saying we're done down here, we're done up here, we may revisit it today, but right now we're done. And if price revisits the end of an auction and you start getting volume, volume always means acceptance. You start getting volume where an auction had finished, that gives you a significant amount of information about what buyers and sellers are doing. So the finish is that tapered end of the profile that shows participants leaving the auction. And I'm going to show you examples of that. So let's take a look at the attributes. I'll go through this a little bit quicker. Some of this, I don't want to be repetitive, but I want it to be effective. All volume, principles of the volume bars. It's all volume that's included, that's for every executed contract, every order executed at each price. It's the amount of volume at each price that shows interest in executing orders, again, at all prices. When there's less interest, there's less volume. When there's more interest, there's more volume. If price is going down and there's less interest, as seen by the profile, you know that you can begin looking for evidence in the print that the other side is stepping in, and voila, you have a long opportunity. The next one is the principles of the volume point of control. It's the most fair price. So we may have in a profile several high volume areas, but the volume point of control is the most fair price in a profile. It means that when a price fails at an extreme, either to the low, the downside, or to the upside, it is most likely to go back to VPOC, which is the most fair price. It's the point from which value is derived. Therefore, VPOC can shift. VPOC can move in a day. And if VPOC moves, it tells us something. And it's indications of direction of value and price. So if we start in a day and we start a profile and we have VPOC at 1923 and price starts moving up and the profile now shows a shift in VPOC to 1926. One of the things I want you to get as just an automatic response, just like you stop at a red light, you stop at a red stop sign, make this an automatic response. Where there is volume, there is typically acceptance. There is acceptance. So when the volume profile starts building out and the VPOC shifts, what is that? That is telling you that you have acceptance higher. And then you're watching the print, because that's where you can take a breakout. You get acceptance higher and you see the print coming through, you're typically going to be able to take a breakout and watch the price continue to move in that direction. It's different across time frames, daily, weekly, monthly. So I could have a daily profile, a weekly profile, a monthly profile, and I would have different volume points of control. Remember, I give more weight to the most current context. The next element is this bell-shaped curve or price distribution, these zones. And remember, volume increases as participants enter the auction because they see fair value ahead. And to the other side, volume decreases as participants decide to leave the auction because they don't see additional value. And we see that in the amount of volume, and it shows profile. Now at the high point, the high volume area, because both buyers and sellers see value at and around these high volume areas, they are both willing to participate at that price. So they are both engaging in buying and selling. And because they both believe that they can make money, they are engaging. They are actually making market orders, both short and long. And that belief of fair price causes the higher volume. And as price moves away from fair price, fewer participants believe that they can make money. So we see the volume shrinking. That's why we get this distribution. That's why we get this bell-shaped curve. And what's cool is I'm going to show you this in different markets. The principles of the high volume area. They represent fair price where buyers and sellers are willing to trade. Because it's fair price, we expect price to rotate, right? Both buyers and sellers are active. When both buyers and sellers are active, we expect what? They're going to buy. Those buyers are going to become sellers. Price is going to come down. Those sellers are going to become buyers. And price is going to rotate typically around a high volume area and VPOC. If that does not happen, so if price comes back to a fair price or VPOC and it does not rotate, it is a very, very strong market signal to us that price is not only going to move in the other direction, but it's going to put at risk the next low volume area, either higher or lower. So let me give you an example. If price is coming down and it hits a VPOC or a high volume area, and sellers can't get it through that level and buyers hold and start taking price back up, what that is inherently telling you, remember, high volume areas act as fair prices. So you would expect to see sellers engaging at the high volume area or at the VPOC. If they do and they cannot get price through that level, it no longer will become a fair price. If sellers are telling you, I don't have enough or we don't have enough conviction short to take price through what is considered right now to be fair price, then trust me, when price moves up into that unfair high, that low volume area above, it is highly probable that price is coming through that low volume area. Because why? Because buyers or sellers are going to look for a different area before they start engaging. And that different area is the high volume area above. It's also why when price comes through to the upside of a low volume area, I will look to take a long on a retest and look to take the trade back to the next highest high volume area. Fair prices, high volume areas act as magnets when price gets rejected either above or below, because the auction will facilitate trade back to high volume, back to volume. It is a fundamental job of the market to facilitate trade. And if the market is doing a poor job of facilitating trade represented in volume, it will move price back to a point that it will facilitate trade, which is a high volume area, because that is the job of the market. High volume areas can often provide excellent target areas for trades. So if you want to get more out of your trade, don't look at where price is. Look at where it's likely to go, especially if the print is confirming. All right, next one. Principles of the low volume areas. Low volume areas are unfair highs and lows where buyers and sellers typically do not want to transact business. They typically have one or two effects on price. Either moves away, kind of bounces off like a brick towards the direction it came, or it moves through as a spike of volume and moves towards a new fair price. Either way, price typically moves away, right? Low volume, the market's job is to create volume. At a low volume area, price is going to move away. It's either going to move away quickly to the other direction or move through very quickly. If it does not, so for example, if we have a low volume area, and this happens a lot in the day time frame, we have a longer term low volume area, and in the day we are getting, it shows us as a high volume area. We're getting VPOC, we're getting rotation around that low volume area. It speaks volumes about what to do, more importantly, what not to do. And what not to do is to trade. So when you have a longer term low volume area and in the day time frame, price is rotating around that, and you can see in the day volume profile a high volume area or VPOC, you sit on your hands, because what it's telling you is you have a battle at typically an unfair high or low, and one of those sides is going to win. You do not want to be trading in that battle. Trading up against unfair prices provides excellent risk-reward opportunities. And let's take a look at the principles of the value area. Again, it's calculated from VPOC, and therefore VPOC will always be inside of value. Technically, it's one standard deviation. 68.2 is the technical number. Most systems use 70% of the total volume to either side, higher or lower, of VPOC. Therefore, where VPOC is in the value range is very important. So if VPOC is at the top of the value range, that tells us something about the structure and the interests of the market participants. If it's at the bottom of the range, it tells us something as well. Again, it's all building a story. We look to the print to confirm that story, and we get into trades. And we have a lot of confidence because of the market structure and things like where VPOC is relative to value of what is most likely to happen with buyers and sellers at specific levels. If price moves away from value, one of two things happen. Value is either going to continue to follow price, and there'll be most likely acceptance, a new fair price, maybe a VPOC shift, or price is going to return back to value. And then most likely, if price gets rejected, it's going to return back to the high volume area or VPOC. And finally, this thing called the finish, principles of the finish, it's the physical evidence in the volume profile that the auction to one side may be ending. When I say may, it's because especially in a developing auction, there are times when the auction is developing, you can see on the profile, buyers or sellers are stepping away, doesn't matter which side, and then buyers or sellers will re-engage in that area, and they'll open up the auction again. But that's a good thing because it tells us a lot about the conviction levels of those buyers and sellers. It can be used with order flow print to determine if aggressive volume to one side is in fact going away, and new volume on the other side of a finish. So let's say an area looks like it's tapering off, and let's say to the downside, it looks like sellers are going away, buyers are coming back in. If sellers re-engage and we start seeing a lot of activity back to the bid, that gives us a lot of information about the conviction of the sellers. And if they re-engage that area and that auction continues further down, that gives us a lot of information about the strength, or more important, weakness of the buyers and the strength of the sellers. All right, so it shows us a potential end to an auction. And somebody had asked me about scalping with this system. When you have a finish, and we're going to see this in a couple of different examples, a finish to an auction, and you have a print, let's say a finish to the downside, the print goes weak at the bid, strong at the offer. You want to talk about great scalping opportunities. It's that. When you have a finish and price is starting to turn around, it will usually go a point or 2 points, and depending upon what you consider to be a scalp, and you'll have a pretty good trade. So that is the volume profile elements and fundamentals. Oh, settlement price is 32. Yeah, you're exactly right. I'll show you. Yep, you're right, and that would be one reason why I would consider for price to go to 32 today. Not because it's settlement, but that is, when I talk about confluence, that is perfect confluence to what else I'm looking at in the market, and I'll show you what I'm looking at here as we kind of get through this. So that is the elements and the fundamentals of the auction, of the volume profile. And so again, things like low volume area. Low volume areas are unfair prices. They're places that buyers and sellers have shown they're not interested in doing business. Price is either going to bounce hard off them, or they're going to come through like a slingshot. If they come through like a slingshot, it's typically, I can't say every single time, but typically going to be associated with a large volume spike. And here's and you're going to learn this, but here's a good indication. If we get price that moves through a significant low volume area and there's no volume spike, it's most likely a stop run. It's most likely a stop run. Price is going to come back, and we'll eventually get that bounce, but it's most likely going to try to stop us out. So high volume areas, it attracts price. It's a magnet. We get rotation. The price distribution, that bell-shaped curve, occurs because buyers and sellers see a fair price. They're willing to engage, and when buyers buy at that point, then they start selling and they taper off. When sellers engage at that point, then they become buyers and they start tapering off. All of it means is that that fair price, that high volume area, keeps attracting more and more business. More participants are willing to enter at that price, both long and short, than any other price in the distribution. We'll also see as a characteristic of that price distribution, low volume area at the top, low volume area at the bottom, and a high volume area in the middle. So different elements and attributes, as we start getting into examples here, it's going to become more apparent what those things mean. So defining the rotations, again, this is how we're getting into now how the order flow in the auction starts to create the volume profile. The dual auction, price going up and down, price going up, price is too high. It's the example of the football, Super Bowl tickets, price is too high. Sellers step in, excuse me. Okay, sellers step in, they start engaging, they bring price back down because value is lower. It causes rotation intraday. And once you understand that and you can start to define what those rotations are, what they're most likely to be, you can effectively trade those distributions. Every rotation, up and down, has an associated volume profile. Those different rotations are driven by different market participants. And the volume profile with each small to large rotation provides the insight for low risk, high reward trading opportunities as I identify fair and unfair prices. And finally, they also show buying and selling interest between the buyers and sellers across various swings and time frames. So what does all that mean? They're all great words, but what does it mean in a chart? What does it mean to us as traders? Get rid of these two profiles here. Okay, let me go back to this. And I built a volume profile as price started moving up to this swing high and just beyond it. And I can start to identify low volume areas. Here, here, I see VPOC. And what I want to start to do is identify low and high volume areas. So as price starts moving beyond these levels, so for example, here's a low volume area here. So I'm going to try to blow this up so you can see it. I've made these bars very light for a reason so that the volume profile kind of sticks out. But I made this volume profile up to this date. And you can see that right here. So now on subsequent days, what I'm looking for is, and actually that goes up to about right there. See that low volume area, the high of that? We have a range of low volume from here to here, but if I'm making a trade, I may have to get in right in front of this low volume area, but the safest trade, best risk reward is right here, because if price comes, if I get in at this level or right here, and I'm looking over here, if I get in here, my risk is pretty small. I'm out if it comes above this level. Whereas if I get in front of this low volume area, I have to give it a lot more room before I know I'm wrong. So this is the level that I'd be interested in. I've made it up to this point. Let me do this. Okay, there is my line. And now I'm trading, looking to trade the next day. And I have this low volume area, right? I can see that right here. And what am I doing? I'm looking for a short up against this area, right? Because price has come down below it. I'm looking at this now because price is in this distribution right here. I'm looking at this as an unfair high. Buyers need to push through hard with a lot of volume and maintain that. So once they get price through, I need to see an intraday volume profile growing in volume above it. They need to maintain their efforts above this level. But otherwise in the market now that we've come through this area, this is now an unfair high. And this is an unfair low. But this is my distribution. This is the distribution of price that I'm in. And what I'm looking for the next day is a short right here. And what you can see is price came up to 65.25, up to 1 point, and then came down. Not only did it come back down to this low volume area, but came down through that low volume area. And then look what happened. This is one of the things that I talked to you about. You see this volume point of control right here at 53? Everybody see that? That yellow line at 53? It's faint, but can you see it there? Yeah, okay, good. Once price came through this level and came back up, remember what I told you about high volume area or volume point of control? When sellers can't get price through that area or buyers can't get price through that area, What did I tell you would happen? Likely to go very strong in the other direction, right? Why? Because when you think about the auction, that's why everything to me is about the auction. When you think about what's happening in the auction process right here, up to this point, these buyers and sellers have shown that this is the most fair price. Now price comes back up above it. It had already rotated down, which is exactly what I expect. I expect rotation through a high volume area, back up through it, comes back down to it, right at this level, and bounces off it with responsive buying, right up through that low volume area. And what's happening in the auction here is when sellers don't have enough conviction to push price through what they have considered to be fair price, then look out above. It's the same thing on the other side. When buyers don't have enough conviction in a day to take price through VPOC, fair price, then look out below. What it means is that this low volume area is at risk. Most likely is going to be broken. And so the trade I would look for is price to come through. You see how it bounced off? I would look for price to come through, show me the conviction. See how it came right back down to this level, and this would be my long. Why is this my long? Because this now, when price moves back above it, this now becomes an unfair low. Unfair lows, I'm looking for a long. And what you can see happen right here, price came right back down to that level, and what happened to it? Took off. So once you have gone through the elements now, and again, we're going to go through this over and over and over again. You've gone through the elements now. You understand to some degree the attributes of those elements, and you understand low volume areas, unfair highs and lows. It's one of the reasons why we look for trades around those levels. Price moving back to fair price, right? Here's the most fair price of this range. You can see all kinds of rotation around it. Does it make sense what I'm telling you? Price comes down, comes back up. You can see the short off of this level, all the way back down through it. We're rotating. It can't get through. Thank you, David. It can't get through. And if it can't get through here, sellers are, look what happened here. When sellers are saying, we don't have enough conviction, we're not willing to spend the money. Remember, sellers have to take less in order to make a market order, and market order is the only order that can move price. They're showing they have no conviction to get price through fair price. And so what that's saying is we don't consider this to be fair price. If we don't consider this to be fair price right now, then we are most likely going to relent, and we're going to wait for another area to be fair price before we re-engage. And it's not likely going to be this low volume area, this unfair high. They're most likely going to wait for this area. So price came back up. It came through. Here's our long. This would be the first place we're looking for a short. There's our short. Boom. Came down all the way through. We get some rotation around volume point of control. Sellers once again said, nope, don't have enough conviction. I'm not willing to put my money here. I'm not willing to create more market orders to take price lower. That's big red flags that say sellers lost conviction. If sellers lost conviction, I expect them to find a new area to engage. And it's not likely going to be this area. Good, I'm glad this makes sense. I'd like opportunities outside of value. Am I too strict? No, I don't think you're too strict at all. I just think that you need to understand, not understand, but apply the context of value relative to your trades. And it sounds like in that case you would like to be taking trend trades, right? Because as the market probes outside of value, it's pushing. It's pushing either higher or lower. And that is typically a trend. And what you'd be looking for in that case to support further movement is you would be looking for value to keep moving lower with the move. Let's see. So would I reverse at that level for a short right here? Yes, this is where, right here is where I would look for my initial short. But I would need the print to confirm. The print has to confirm that, in fact, buyers are stepping away and sellers are stepping in. And remember, I look down one or two levels to see if that holds true one or two levels below, because a lot of times what I'm going to see in the print, let me show you. A lot of times what I see in the print, buyers and sellers are tricky, is let's say I have an area right here where I want to short, and I see the weakness at the offer and strength at the bid. I'm like, oh, that's awesome. That's what I'm looking for, right? And then below that, I'll see buyers pushing. This is an example here, but I'll see buyers pushing and weakness at the offer. I'm looking at that going, well, it could work, but if I start getting, I could take the trade, but if I start getting any strength back into the offer at 30.25, 30.50, I'm out of this trade. Because I have active buyers right here. And for example, if there were weaker sellers, if we had weakness to the offer, which we don't in this case, but we have weakness to the offer below this perfect, what looks to be a perfect setup, I'm a little bit weary, right? My job is to manage my risk. That's my number one job. And as I do that, I have to identify where buyers are. If I'm looking short, are buyers really relenting? And so I better start to see weakness or a lot more strength in the bid. And it doesn't mean the trade won't work. All it means, if there's strength at the offer, weakness at the bid below this level, is there's additional risk in the trade. And I just have to understand that so I can watch for it and manage my trade effectively. Does it mean that sometimes I'll get out of a trade and it'll still work in my direction? Absolutely. That's exactly what it means, and that happens to me. I won't say a lot of times, but it happens to me. And I believe in trying to take a trade to its fullest advantage, its fullest extent and range. But I also believe, and we're going to talk about this on Thursday as we start talking about trade plans, actually end of day tomorrow and into Thursday, as we start talking about trade planning, is as you are trading through the day, you really need to understand what is your profit objective for the day. Now, everybody's different, and I can't ascribe to you, and some people have asked, actually, I get a lot of questions like, well, if I have an account of $10,000, what should my target be for the day? How much money should I be making for the day? How much risk should I take for the day? Well, I can give you some standard numbers, but irregardless of that, you should inherently understand what you're willing to risk in a day or a week and how much money you need to make for your trading business. So when you walk into a day, you inherently understand, today my profit objective is $300, or today my profit objective is $3,000. You understand the context. For example, we're into August, and we're moving into what I call the dog days of summer in terms of the ES and price movement. And we don't get as much price movement. So that means if my profit target is $1,000 a day, I'm likely not going to get that much range. So I'm probably going to have to up my contracts in order to make that much money. Or I can move to something like oil that has more volatility, but also offers more risk because of that volatility. So I have to make a decision about how much I need to make, how much I'm willing to lose in that day, and when I hit those targets, I'm done. And if my target for the day is 500, and I get into an ES trade with 3 contracts, and I'm going long, and it goes 2 points, I get in with 3, goes 2 points, and I see all of a sudden it gets really weak at the offer, a lot of strength coming in at the bid, and let's just say it's a key level. Well, I'm either closing that trade and taking that $300, or I'm taking 2 off and seeing if the other one will run. Because if I know my goal, my objective is $500 for the day, and I have 300 or less, just under $300 in a trade, say 275 in a trade, I only need $125 for the remainder of the day. Now I'm looking at two contracts in a trade looking for 5 ticks. That's a lot easier to get to, and I've met my target. So one of the things we're going to talk about, and this is really important, understanding what your profit objectives are so that you can manage your trades to your profit objectives. So that what you can do in your trades, if the print is telling you there is additional risk to the profit you already have locked in, risk to your initial trade, then you can effectively manage that risk and do it objectively. But if you have no idea what your objective is for the day, and it might be $200, might be $3, $5, whatever it is, or what your risk tolerance is for the day based on some kind of business plan, there's a really good chance, there's a high probability that your account will continue to dwindle. So what we're going to talk about is, right here, as I have an opportunity for a trade, and that may be long, I would have to look at this and say, where are the 2 areas long that this price is likely to go? 59, and here's another higher volume area here at 62.75. If I'm looking for 500 in a day, and I'm looking to take a long off of this level at 56.75, unfortunately, I'm going to look at the print. If the print tells me that things are stopping here, I'm going to have to take some off. That's okay though, because I'm looking for potential of this area and potentially this area with 1 or 2 remaining contracts to get me to my 500 or closer to my 500. Does that make sense? And what I can tell you is the more that you can begin to align your profit objectives for a day and have that in your mind and what it takes in terms of number of contracts and points, ticks to get there, the more that you can do that, the better risk manager you will be, the more objective you will be, the better that you will manage your risk, and you are more likely, once you get into a scenario, you're making profit, take the 3 contracts, you made 2 points, and all of a sudden the print tells you, whoa, buying is done, we got more selling coming in. You now, instead of going, man, I hope this continues, you can make a conscious decision and say, okay, I would expect a pullback. I'm going to take 2 off, and I'll look for a pullback to this area. If it continues, I could add back into this trade 1 or 2 contracts. My ultimate target is this. And so you can start making decisions to take your profit, minimize your risk, and help yourself, give yourself a much better chance of achieving that objective for the day. And managing your risk. And again, we're going to talk about this when we get into psychology, and I'm going really long here today. I'm sorry for that. But when you get into a trade, and it looks like it's starting to work against you, and it's your first trade of the day, tell me that isn't a killer to your psychology when your first trade of the day is a loser. And now you know you got to make $500 or you want to make $500 and you're down 150. Tell me that it isn't a killer to your psychology. But if you get into your first trade and it looks like it's starting to move against you, your risk is higher, and you get out of that trade for a 1 or 2 tick loss. So let's say you're down 50 instead of 150. You walk into your next trade going, yeah, I managed that trade pretty well. Even if the trade worked in your direction, if the trade starts working in your direction, you have the objective mindset to be able to get back into that trade, and you know where it's likely to go. I usually kick the dog. All right, so we're going to talk about that when we get to psychology. Like I said, I can, unfortunately, and I told DB this, my issue as a trainer is I can talk all day. So I want to get onto the content and respect people's time. So those are the rotations, and that's how we start to use volume profile as it develops. The next thing that I would do in this, there's my volume profile. Next thing I would do is, let me scrunch this up a little bit more. As price is moving up and down, I would continue to build volume profiles as price moved higher or lower. And what I would start to do, you see this volume profile has VPOC here at 71.25. This VPOC is here at 52.75. What this is telling me is this market is accepting higher prices, and so the potential is still higher. So I'd keep building these profiles. I would also extend this profile all the way out to the current date and start looking at how the market structure is changing. And then I would look for areas like right here where there was confluence across these areas, low volume areas, high volume areas. I'd look for confluence, and I would keep building these out. And these swings are just different time frames. But everything I'm showing you, this is a 3-month chart. Everything I'm showing you is exactly what you would do within a day time frame. Exactly. Instead of a 3-month chart, you got a 3-hour chart. The time frame is just shorter. But the principles behind this are exactly the same. That's why I'm telling you, if you understand the fundamentals and the attributes, right, the elements and the attributes, you can begin to start to apply this in different ways in different markets. So again, composite, it expands across several to many days, relevant for the price area that current price is in. So for example, I don't want to be doing a composite volume profile for prices that are in the 1800s on the ES. It's not relevant to the current market. A user would want at least a swing high and a swing low in a composite profile. An intraday volume profile that is typically specific to a session time and measures the most current activity between buyers and sellers. Should be started at the beginning of a market session. As structure builds, we look for unfinished areas and volume point of control. And the intraday volume profile is considered to be a developing volume profile and is subject to change. So as you begin a day and you get a volume profile started, and I'm going to show this to you here. I've got one going from the beginning of the day. So what I can see is a low volume area, 23.25. I'm going to take these, actually I'm going to call that 22.75. The open is right here at 23.25. These were low volume areas from the pre-market. We have a really nice distribution. Look what we see at the ends here though. Remember this finish, this nice taper? Look at what's happening. Get a nice taper, a nice finish. If price comes back up and we start seeing in the volume profile, volume building, even just in the profile, you don't have to see it in the print. If you see volume building here at 30.25 and we start moving higher, what you're going to see is a volume building. That tells you that there's conviction. You confirm it in the print. You're looking for momentum dots. You're looking for the volume cluster analysis to confirm with that. And now you have, as long as it stays a low volume area and price moves above this level, guess what you have today? You have the makings of a good long off of around 30.75. You're going to go back to the print once price pulls back to 30.50, 30.75. And as long as the print confirms, the bid gets weak and the offer starts to get strength, you're going long. You're going long. All right. We use composite and intraday volume profiles to create our trading plans. So I want to be real clear about this. When we start to look at building our trading plans, we use composite and intraday volume profiles. We use intraday only volume profiles and the print to confirm, enter, and manage our trades. So the way this works and how we're going to do our trade planning is we're going to look at some historic composite volume profiles. And remember, I go from outside in. I give more weight to the most current auction. And then as we look at our day and we start seeing how the profile is developing. We're looking for confirmation or not, is the market changing, of what we've seen in our plan, what we expect to happen. We're prepared for price to go higher. We're prepared for price to go lower. If price does this and we see this in the print, then we're going to do this, and this is where our target's going to be. If it goes higher and it does this, then this is going to be our trade, and this is where our target's going to be. This is where our stops are going to be. We have that plan in place. Then we're going to use the intraday volume profile and the print to say, is the story the same? Is what has been happening in the market still the same story? And if it is, I have a lot of confidence in the trade. So I can get beyond trades that I hope will work and trades that I have a lot of confidence that can work and trades that I know I can manage effectively. But we use the intraday activity to actually manage our trades. Developing volume profiles. It applies to daily volume profiles. I call it a developing profile. And markets also that are moving into new highs. Like the one I showed you where it moved into a new high, there was a pullback, moved higher, another pullback, moved higher. And I develop a volume profile for it, but it only represents the swing high, only represents the interest relative to high and low volume areas for the buyers. As a volume profile develops, it will show a potential finish to one side. Here, let me show you this. Here's today. See the finish? See the finish? Is that a good opportunity for a trade? Are these good opportunities for a trade? All of them. You bet they are. Take a look at yesterday's profile. What do you see at the bottom? Nice finish. What I call a finish. What do you see at the top? You see that taper? Going away. Participants are going away. You get up there, you look in the print. Does it confirm? Right there. Confirm the short? You betcha. And what do you do? I mean, this is so easy. It's funny. You get into the trade. It confirms the short because of the weakness at the offer, the tapering. You get into the trade. This is so easy. You're going to laugh. Let me open this up a little bit more so you can see it. So I have strength. I gotta make this a little bigger. Okay. We had actually relative neutrality in terms of the auction, not strength to the bid or the offer side. We had momentum in this bar. We had a cluster that showed the majority of volume in this cluster came in at the offer. So everything would suggest long, and then it went neutral. I mean, there wasn't continued strength on part of the buyers in this bar, and the profile showed that participants were stepping away. So we had a probe lower, and it came back up. Clear weakness on the part of the buyers. More strength at the bid. There's my short. All I need to do with this trade is, if I get any strength coming back in at 36.75 and 37, I'm out of the trade. Or I put my stop simply about 1.25 points up above this level to see if this is still going to hold. But I can manage this trade effectively if I start seeing strength come back into the offer at 36.75. And the way I look at this is, even if I have to take a break-even trade and price continues higher and I get weakness at the offer again, and the profile doesn't show any more volume, it still shows that nice taper or finish, oh, guess what? I have an opportunity to get back in up here short. And now my risk reward is even better. So the finishes provide opportunity, and when trade moves back up into those areas where the auction looks to be ending, you have opportunity for trade. So an unfinished area, let me see if I can find one. It would be in a developing auction, Dirk. An unfinished area would be in a developing auction. I have to find one for you. Not typically not. It's a great question, Ben and Dirk. You know, an example of an unfinished auction. You know, let me do this. It's a great question, and it's hard historically because um, because no, it's difficult historically because you get these finishes. Look at the ends of these days. Finish, finish, finish. I mean, it happens every single day. Finish. Where is Friday? Let me find Friday. Now, those of you who were in the room on Friday and I was talking, I was looking for 1932 as a target. And the reason I was looking for 1932 is because that auction hadn't finished to the upside. And I could clearly see that the yeah, right up here. And it's not going to show me as well right here. Part of the print too showed that this auction wasn't finished, which is why yesterday I looked for 32 again. For those of you who were listening to me on Friday, I said I was looking for a target of 32. Sellers decided on Friday that it wasn't happening on Friday. So yesterday, when price started poking its head above this 26, 27 level, that was exactly where I was expecting price to go, is back up to that unfinished area. So if I look at today's auction, you know what? Tomorrow morning when the market opens, I'll show you what an unfinished, remind me if you will, I'll show you what an unfinished auction looks like. Because we usually get an unfinished auction to both sides at the beginning of the day. But right now, this is you can see the ends of this, both finished. So remind me. And they don't, right, they don't stay unfinished historically. All the finished market says is right now at this point in time, the movement to the upside, the movement to the downside is stopped. Now, if that comes at a key level, right? So if it comes at a low volume area, you've planned a trade. Let me just take a look here. You've planned a trade for a long today at yesterday's low. It's a composite low volume area at 20. We get down to 20 and you see a taper and a finish to the downside and you're in long down here. As long as this holds, you have the potential for an amazing trade. Amazing trade. Now, what likely happened here is this showed an unfinished auction at 2050. And when it moved back down, it quickly finished. We had responsive buying, and it quickly finished, and there was likely a decent trade. But when you have that finish and you catch that trade, it's like catching a great wave. The only time you'd want to get out of that trade is if for some reason you started seeing price moving back down towards 21, 2075 with a lot of strength back at the bid. But otherwise, as long as the finish holds, especially at a key level like the previous day's low, it represents a good trade. You can, yes. Question is, would you typically need to load replay data? Yes, and you know, and I can tell you that I'm lost my train of thought, but the the IQ feed data is excellent data because, as DB has talked about before, it gives you true historic tick data. But if you're looking for simple volume profile data, you can get that in minute data as well. Make sure I've got these questions. So, and don't forget now, as we start getting into trade planning, and then Thursday and Friday, I'm going to show you trade entries. I mean, I'm actually going to take my chart, I'm going to take my account, and we're going to get into trades, and I'm going to show you specifically why I'm getting into a trade, where I'm getting into the trade, and how I'm using the print to manage that trade, where my target is based on everything we talked about yesterday and today, where I might scale, why I might scale, all of those things we're gonna get through. You're gonna see the unfinished auction and how it all develops. Yeah, tomorrow, just remind me tomorrow morning, and at the open, I guarantee you we'll have an unfinished auction. Guaranteed. How do you like that? A training course with a guarantee. How many price levels constitute a finish? It's not a price level. A finish is really just an area where it shows a tapering of the. But wait, there's more. Where there's a tapering of volume. So just like the Super Bowl ticket analogy, when participants stop seeing value in a specific direction, so buyers start going, it's already gone up, I'm not really going to make any money. They lose conviction. You start seeing strength coming in back in at the bid. The print shows, or the profile shows that they're stepping away. What you will typically see almost all of the time is this finish. You'll see this taper on both edges. In fact, there really are very few days that I ever have where I go back to and we don't have this this tapering, this finish. This was yesterday's, real quickly while I have it up here. This was yesterday's profile right here. One of the reasons that I look for 32 is not just because it's settlement, but you see this thin volume. You see this, it looks like broken teeth right here, high volume here, high volume here. You see this structure right through here? That is a very weak structure in the market profile. That's very weak market structure. And whenever you have weak market structure, and typically is defined by a trend, price moving very quickly up through an area, never coming back, or very quickly down through an area and not coming back. When price moves back into that area, it will typically, now remember, this market wants to build out this this distribution. That's the way the markets work. It's a series of inventory control, people buying, they turn into sellers, they sell, they buy more, people sell, they buy. That's what creates these distributions. That's what creates these bell-shaped curves in almost every volume profile. When the volume profile doesn't create that and it has this ugly area, it leaves these holes, when the market moves back into that area, it typically will fill this in. So what I was looking for is price once above this level, and it just once above this level, to continue up and build out the volume. Actually, at the beginning of the day, what I was looking for is a range between right down here, which is 25 up through 32. And if that doesn't happen, and we continue to get push lower and even some extension lower, then that gives me great information about the conviction level of our current buyers, right? It's gone. It's not there. We're at a point where in the overall market, we have the, bring this up. It's a point where we would look to see price start rotating higher, right? Remember, the market rotates, right? Up, down, up, down. Well, it rotated down. Now it rotated up. Where did it rotate up to? That low volume area, perfectly yesterday, is rotating back down. And what I want to start to see it do is rotate back up here. If it doesn't, if it starts to generate more volume to the downside, well, guess what I'm doing? I'm going over to this data, and I'm going to start looking at the profile data below this area, because this is where it's most likely going to come, is down below this area, and we'll see further movement to the downside. So it's a continuing developing story, and that's how we build our daily trading plans. A weak structure is basically elongated LVA. Yep. Yeah, with one of the characteristics of weak structure is kind of what I call broken teeth. You get these high volume areas, low volume areas, looks like a bunch of piano keys or broken teeth over an extended range. So developing volume profiles, we use typically for the day, and we look to use it to identify the developing structure of the market. So let's talk about a few patterns, and I know we're getting late. I apologize for that. I'm hoping that the information is good, though, and that it's making sense and it's worth your time. Let's talk about a trend day. One of the characteristics of the volume profile in a trend day will be this. We will see multiple price distributions. So we see for example, we see a price distribution here. I don't want to screw anything up, but maybe we see one here. Here's a low volume area. We see one here. Here's another low volume area. We see one here. So you see these distributions. See how the market builds these distributions out as it goes along? And this is just simply because of inventory management, buyers selling, selling and buying, participants selling and buying, selling and buying. But the emphasis is to the downside. And many times in a trend day, what we're going to get, hang on a second, what we're going to get is we're going to see these distributions. We're going to see, in fact, what we'll typically see is VPOC move lower or higher, depending upon the trend. But this is a volume profile signature of a trend day. Now remember, price will continue to move until the other side steps in to shut that movement off. So if we have a trend day beginning to develop, meaning that we get a distribution, and then we get a low volume area, we get another distribution, we get another low volume area, and it breaks through, what we will typically see, and you can see it right here, is when price pulls back up to this low volume area, what are we looking for? So far, can somebody tell me what we're looking for? We're going to look for the print to give us our trade confirmation, but what are we looking for in the print at that level? You're looking for a short. There could be a potential stop run. You're right. The low volume area actually goes right on up through there. But what are we looking for in the print to tell us it's time to go short? The offer, exactly. The offer is weak and strength at the bid. Thank you. Absolutely right. So in the print, when we see a weakness at the offer, strength coming back into the bid, we're short. What happens if the strength comes back into the offer? We don't care about that. We manage our risk. We can say, that's okay, because I have another trade opportunity up here. If I see that same activity, weakness at the bid, strength at the bid, weakness at the offer, I'm short again. I don't need to take this up here to figure that out. But this represents a very good trading opportunity, right? Look at what happened here. Price came through. Look what it did. Moved right back up to that low volume area. Same thing we'd be looking for in the bid. And this is one of the ways that you can take advantage of a trend day. There's also, and I think you've seen this before, looking at a structure chart using volume cluster analysis, identifying where volume, let's say price is moving lower, where sell volume or volume at the bid is coming into the market, and draw that trend line. It's another great way of getting in on a trend day. But this is something that's going to show you that the trend, there's a potential here for a trend day. The volume profile with this structure, with this pattern, is supporting the trend day because we're getting acceptance, acceptance lower, acceptance lower, acceptance lower. Okay, so multiple price distributions in high volume areas as price is moving in a specific direction. Trend days are imbalance days. They're typically, not always, but typically followed by balance days, so that it gives us information in terms of planning for the next day. We use low volume areas from the trend profile as potential trade opportunities. I showed you that. When price moves back up, right, that low volume area, once it comes through, is now what, an unfair high. Price moves up, we're looking for buyers to go away, sellers to engage, and we go short. However, if and when an unfair high is broken, it then may become an unfair low. Price will continue to move. You got to remember these principles because you got to be ready for it because you don't know what the market's going to do next. Price will continue to move in a specific direction until the other side steps in. So at the end of a distribution to the downside, right, this is our developing pattern, and we start getting down here and we see some finishing, right? We can't see all of this that's going to develop. If we start seeing responsive buying at these levels, we just need to understand that any trade, any further trade to the downside is at risk. It doesn't mean it won't work. It just means the risk is a little bit higher. And that's where I eventually want to get you is, first of all, using the volume profile to identify trade opportunities, how to plan for it, how to manage your plans intraday, and then using the print to effectively manage your risk and to your profit. However, if and when unfair price is broken, again, it may become an unfair low. That's the whole scenario where resistance is now support, support is now resistance. And again, once price comes through an unfair high or low, it's most likely to move towards the high volume area because what? That's fair price. So in the trend, each low volume area is considered to be an unfair high if price tests up next to it to the next day. So let's say this is our day. And the next day we're trying to create a plan, and let's say price closed down in this area. I can draw. Let's say price closed right down here. Right? There's settlement, there's a close. And the next day starts, and it starts back down in this range. Right? Starts in this range. First thing we're going to do is say, okay, at that level right there, we're going to look at the bid and the offer. We're going to see what happens. There's a short opportunity, and what we want to see is this still an unfair high? If so, we may have room to the downside. Well, what if price opens up in this range between these two levels? Well, if we have a test lower, we have a potential long right here. Maybe as far down as here, but we have a potential long right here. We have a potential short here and here. If the print tells us this is a good short, right? The offer gets weak, bid gets strong, we can take a short and we know how to manage it. We'll look for our next level. We don't care if we get a tick or 2 ticks. I don't really care about that. I'd rather manage my trade, get a tick, 2 ticks, or break even, and get a better trade entry level lower because now I got a larger range because this is where, if this works, this is where price is likely to come to, as opposed to this. I'm going to make that back without any problem. So I don't care, right? And I'm not sitting down 150 or 200 bucks in the hole knowing I got to make it up now in this trade. My psychology is intact. I can still manage objectively, and that's important. So if price opens up here, guess what? We've got trade opportunities here, here, and up into here. So we can start identifying in the next day, looking for price to do some balancing. We can start looking for these as trade opportunities. If, for example, price opens up and let's say it opens up here and we start getting movement to this upside, let's say it stops right there, right, and it moves down. What is this telling me? It's building out this volume right here. It's telling me in this market we're getting price acceptance today, right here, and that my next likely trade short is going to be up around this level here. And what I'm expecting to see after the day is either a price distribution that looks like this or one that looks like this, and this is going to start to become VPOC. And just simply because I understand that the volume profile, I'm going to show you an oil one, it works the same way in every single market. The elements are exactly the same in every market. Let's see. Would the low volume areas be considered areas of liquidity where traders want to move price to? The low volume areas would be where the market is likely going to move price away from. Because it's low volume, the market's job is to generate trade transaction, and where it's not doing a successful job of generating trade, it's going to move to a new area. where it's generating trade, and that's the high volume areas. So the liquidity would come more in the high volume areas than in the low volume areas. But it's a great point, and I'm glad to see that you are identifying the concept of liquidity and where liquidity would come in relative to a high and low volume area. The only difference would be that it would be at a high volume area. Yep, you're welcome. And Michael, yes, high volume areas are magnets for price to go to. Yes, inside of value at VPOC, exactly right. Do I ever look for a certain number of high volume areas to form that might start to signal the trend is getting very late, sort of similar to the fifth wave and Elliott wave? Not that I use it. Okay. I look for the positioning and activity of high volume areas. So for example, what I'm looking for is, where's VPOC in the value area? Is it high? Is it low? That starts to tell me something about the overall market. So I'm not just looking at the high volume areas. I'm looking to see what is happening with price around those high volume areas and where value is relative to them. And I'll go through that as we kind of get into the next couple of days. So some other patterns of volume profile: a B pattern. A B pattern is you get a fast start and thin volume to the downside in the day, and then it's followed by two-sided trading and a bell-shaped curve for the remainder of the day. This structure is telling you that sellers had a lot of conviction at the beginning of the day, and through the end of the day, that buyers started holding, right? Buyers started two-way interaction. We got a balance, and knowing that the markets move from imbalance to balance, one of the things you just naturally start thinking about is, if this is starting to become a balance area, and I can see it because there's a lot of activity and buyers are actively engaging sellers, then what is my trade plan? Well, my trade plan may be now that I'm looking for a long the next day here or here, and I would be looking for price to start rotating back up. And we got some weak structure in here, so back up possibly to that level, there would be a target. And if price gets through this level right here, this low volume area, I'm taking a long on a retest, and I'm taking at least to here. And what I really want to see is distribution to there and possibly higher. So this is where I'm going to scale. This is where I'm going to hold contracts to. If I start getting strength back down at the bid, price starts coming back down again, I'll get out of the trade, or I'll give it a little room to break even, et cetera, et cetera. And that's how we can use some of these patterns to generate potential, not even potential, but trade plans. And then we're looking for the day's activity, the day's profile to start confirming that, in fact, yeah, buyers were holding here. Right? We're looking at overnight activity. We're looking at the open. Buyers were holding here. Now that we've broken through this level, we're likely to start moving back up. And now I can look for longs and hold those long positions for higher potential. In the B pattern days, sellers have shown aggression and buyers have held and provided responsive buying from the bottom. Looking for a short at the upper, so in the day, let me just show you. In the day, after we start building out some volume here, VPOC drops, this is where we start looking for a short, right up in this area here. We're looking for a short there to move back down here, and then we want to see, where does the day end? Does the day end down here? Does the day end around VPOC? Or does the day end up towards the top of this profile? And that also is provides some information about the conviction of buyers and sellers. And then the open the next day really helps us as well. The day will close typically inside of the lower rotation. And again, we're just looking to see, is it around VPOC? Is it higher, lower? What is that telling us, and how does that play into our trade plan for the next day? P pattern is just the opposite of the B pattern, and we get a very fast start and a thin volume to the upside. We get followed by two-sided trading and a bell-shaped curve for the remainder of the day. And what this is saying is buyers show aggression. Sellers never push back down into that thin area, but sellers have held in that area and provided responsive selling from the top of the day. And just like we were looking for a short Now we're looking for a long, around this area at the low volume area, looking for a long and for price to remain in that area. Then there are times when price will come through and it will take you out, it will test lower. Anything at any time can happen. But when you're watching the print and you're long and you see strength coming back into the bid, you instinctively and inherently know that your risk is higher. And then it's just a matter of you making a decision. And when you can make that decision, you know you're beginning to trade objectively. And once again, you're going to hear me say it 7 different times, 7 different ways. The only way to stay objective in the trade is using the print, the order flow, to manage that trade. Again, the day will close typically inside the upper rotation. Let's talk about poor structure, which I just showed you from yesterday. Poor structure is this area right here. It represents poor market structure, meaning there's really not a good bell-shaped curve here, right? We're always looking for the market to develop this bell-shaped curve in a profile at some level. And where it doesn't exist, we're looking for the market to come back, possibly the next day. Sometimes it may not be for a couple of days, but when the market comes back to this area, it is most likely to rebuild and build out the distribution. So at the time, it may be the next day, it may be 2 days, maybe a week later, but when price re-enters this structure, you are looking for, let's say you're short, price comes down here, you're short. I'm loving this drawing tool. So price comes through, you're looking to short right here. This is your target. Your expectation is that price will start to build out this structure and will come down there and possibly even down to there. And that's how you're determining your target. So you're looking for this to complete that bell-shaped curve. I'm just, look, I get a lot of questions like, does it have to build a bell-shaped curve? No, the market doesn't have to. But as participants manage their inventories and they buy and they sell, the volume profile just always develops these bell-shaped curves. And when it doesn't, nothing is ever guaranteed in the market, but the probability is very high that it's going to come back and repair that structure, especially if it's in a market in a new area. So that activity, when it comes back down, is likely to complete that distribution zone with a higher area closer to center. So when we look at price and the ES over the last year and a half, and it's been going up and up and up, it will move up, create into new areas, create weak structure, come back, spend time building out that distribution zone. Once it builds out that distribution zone, boom, it's off to another level. It builds a ladder or a rung, kind of like on a trend day, just over a longer period of time. In fact, it's a good example. A trend day builds these distributions on the way up or the way down. Our trend has been for, I don't know how many years now, a lot of years now, to the upside. And if you look at a 7-year, a 5-year composite profile, and just look at the volume profile as price has been going up, all you're going to see is this amazing series of price distributions all connected together. You're going to see price moving up, balancing out, building the base, moving up, balancing out, moving up, and we've been on this trend for a long time. We're not getting off this trend until we get some responsive and sustained selling. Remember, price will continue to move in a specific direction until the other side steps in to shut that movement off. The other side stepping in to shut that movement off is represented 2 ways. Number 1 is responsive selling, meaning that selling occurs because of price, not because of news, but because of price. It is not arbitrary because somebody wants to sell, but it is outside of news. And it is typically a sharp move back the other direction and then sustained. So you're likely to see price rotate back up, but you're likely to see sellers begin to hold and then start taking it to the buyers. We haven't seen that in a long time on the ES. We've had pullbacks, but we've not had responsive selling that has been sustained. All right, let's look at normal. What we see in the normal distribution is VPOC typically is near center. We get a nice bell-shaped curve. Now in this specific profile, you'll see a volume distribution and a high volume area up at the top right here. What this is saying is this market is about to head lower. You got to finish to the upside. Price came up, and this massive volume up here was evidence that because price didn't go higher, this is evidence that sellers were absorbing everything that the buyers were handing them, and therefore the market is likely to move lower, down into these areas. I can take that information and I can start developing trade plans with that information. So the next day I'm looking for a short, not a bias, but I'm looking for a short. The market is saying we're interested in moving lower. You can see price starting to come down here. Interested in going lower. So what am I doing? I'm finding my low volume areas and I'm waiting for a test to those areas. I'm looking to the print to confirm that the buyers in fact are going away, sellers are stepping in, and that's where I'm taking my short. If they prove otherwise, that's okay. I can take a short small stop and wait for them to either confirm that they're going back higher, or this is a stop run and I can jump back in looking for a pretty good move. I'm not afraid of taking a stop, and because typically stops are going to provide my next opportunity. Whereas a lot of times people they don't like taking stops. Nobody likes to lose money, but it's usually just providing you good information. We have a good finish to both sides of the auction, so this is a normal distribution. Again, VPOC is near the center. We get a good bell-shaped curve to the distribution. Price moves to and from high and low. Watch for signs that one side is holding more than the other. Like at the last one, price was holding at the top. You can see that from the volume profile. You can also likely see it in the print. When price fails to get through volume point of control, remember this, when price can't get through volume point of control, it moves off a low volume area back to point of control, and it can't get through it and starts heading towards an edge. That edge is at risk, right? Remember that? Let's see. Just want to make sure I understand. Volume profile is based on RTH. Volume profile is not based on RTH necessarily. I use a volume profile for the RTH session of the ES because the RTH session provides 80 to 85% of the overall volume. So I care about where those participants see their high and low volume areas. How do you factor in the pre-market Euro session? We're going to go through that tomorrow and Thursday. So as an example, I will build a pre-market Globex volume profile, and then when the US cash market RTH session starts, I will just simply start a new profile. Let's see. B profile shorts only. Yeah, once in a B profile, the market is likely to close. Doesn't always have to, but it's likely to close inside of that B rotation. So you'd be looking for shorts at the top of that rotation, back down into value and to high volume and possibly to the low of the day at the highs. Yes, that's exactly right. Would B's and P patterns be considered a variation of an unfinished auction since you are looking for some kind of retest or continuation? When I talk about unfinished auctions, I'm talking about a specific time frame. So a B pattern or a P pattern would be considered a finished auction for that day. Be considered a finished auction for that day, and I would look for the next day's activity and the next day's auction to show me whether or not it is finishing or not. We're going to go through examples of finished and unfinished, and on Thursday and Friday when we actually get into the open and go into the live market, you're going to see what I mean when I talk about this auction's unfinished. It's not, the profile is showing it unfinished. The print is showing it unfinished, and it's likely to come back to that level. The one thing about an unfinished auction is what you can say about it, is the probability is high that price is going to come back and finish that auction. What you don't know is if it's going to be 1 tick or 2 tick or 3 ticks or 30 points. So you only know that in the print. Again, I can't stress this enough. Or you know this from using, a longer-term volume profile to identify where a high volume area is where price is likely to go. But a unfinished auction is just a point in time. A developing volume profile is a point in time indication of the market. It's kind of like reading a book, right? You read chapter by chapter by chapter. You don't know what's going to happen in the whole book. You don't know what's going to happen in the whole chapter until you're done. It's the same thing with the volume profile. You don't know how that day is going to end until the day is done. But the developing volume profile is like reading a book chapter by chapter, and it tells you where things at any given point in time are finished. And at any given time, that auction can reopen to that sign. Yeah, it's hard to write down everything. I think that, I don't know about the slides, but I know that the video will be made available. You don't count an overnight fill of the low volume area. What I'm looking for in an overnight low volume area is what does the pre-market and the RTH sessions do to that at that low volume area. So I'm looking for if the market retests an overnight low volume area that I have identified, and I had that this morning in the chart. If it reacts accordingly, then there may be some synergy between the overnight session and the RTH session, which would give me further confirmation of a trade. So I'm looking at an overnight low volume area, high volume area. All I'm doing with those levels is saying, is the RTH session the same, similar, or different than the Globex or overnight session? And if it's different, I just forget the overnight session. I don't use that data at all. And I focus on the previous day RTH session template and structure for my trading. Would you use Globex for euro and pound volume during the euro sessions? Yes. Yeah, absolutely. Or the you can set your own session for the the European session. You can create a session specifically for that. So for example, when I showed you that 1 minute chart, you can see at what would be my time here. Let me just find it. Again, this is just a flag. You can see when the European session opens, see all the volume, see the volume increasing. So you just start your profile at that session, at this session open. Last night's session filled yesterday's LVA almost perfectly. And that will happen often. And so we're going to use the previous night's session as a reference. So if there is an LVA from the previous night's session, let me go back and look. I want to make sure I answer the question, because some of you really are interested in trading at night, in the overnight. There was a low volume area this morning at 27.75 from the overnight Globex session. And price moved up through that area up to 30.50. A lot of responsive selling off of those upper levels, but as I look at this market, buyers certainly try to get price back up into that upper distribution today and have just failed. So this 22.75 level is going to be pretty critical for those of you who are still looking at the ES today. So yeah, I want to be really clear about this, is the overnight sessions, the volume profile is excellent for. I mean, excellent. In fact, I've given you a couple things. I've given you this first one, which is the closing swing high and low. I've showed you 2 days now. Here's the opening of the Globex session. Let me bring it over because you can't see it when it's on a different screen. That I know for a fact. Here is the closing swing low from yesterday, right here at 31.75. Market opened lower, came up to it. Look at that. Great trade. Then it came up again, went lower, right? I don't know if this was VPOC or not. My guess, looking at just the distribution of price, that this was right around VPOC. What do we have? Weakness, weakness. What's at risk? The upside. Went up just a couple ticks shy of this closing swing high and then failed. Now, if I were trading in the overnight and we start trading in the European session, we came through closing swing high, and in the European session, I was building a volume profile, and lo and behold, there was a low volume area that the intraday session for the European session created here at 33.75, 33.50, maybe at 33.25. Guess what I would be doing? I'd be looking for a long right down here. I'm looking for the bid to be weak, the offer to start getting strong, and I'm long, expecting price to move back up, possibly to the U.S. high. Also, it didn't do that. So once it came back down through this level, if this is European session shows this is a low volume area, comes back up to it, it fails, I'm short. What am I looking for? Most likely looking for VPOC. I actually think this is the session VPOC and possibly lower. Let me go back here. Yeah, looking for this level. VPOC was up here, but it failed to get up through there. In fact, look at where it died in the overnight. The move to the upside, right below opening closing swing high, but look at that, right at the VPOC from yesterday. And what do we just learned today? If buyers aren't willing to take price through and see this as fair price, we don't get rotation here, what's likely to happen? It's likely to go hard and long, hard in the other direction. And that's what it did. I mean, once you understand these principles, I guarantee you'll start looking at, and this is what I do. If price is moving, let's say price has moved huge on the ES, it's moved 20 points, 25 points, and it's coming to a previous high volume area. You know what I'm doing? I'm looking at that high volume area going, that could be a phenomenal trade. If it's coming down and it hits this high volume area and sellers are no longer willing to take it through that high volume area, I can tell you 9 times out of 10, you're going to get a tremendous bounce off of that previous high volume area. At least you know you've got a trade to take up to the higher low volume area, the unfair high. So I hope what you're starting to see is, and let me see if I can get an oil chart up because I want to, okay. I have an oil chart, but no data. Let me see if I can reload my data here. All right. Found it. So here is oil, CL, and this was the overnight session. You can see a low volume area right here. Low volume area right there. Price came down, bounced back up. We got a double top high. Once price moved below this area, and this was pre-market, once price moved below this area, look what happened. Came back up. Hopefully you can see this. I'll try to make it a little bit bigger. Came back up. Where did it fail? Right at that low volume area. Failed and moved lower. In the overnight, it created another low volume area right here. Price moved below that, kept trying to move higher, couldn't. Neutral auction right there. More selling, tried to move higher, finally failed, and boom. And we have not seen this VPOC at all for the remainder of the day. Another low volume area right here. Price moved lower. This is where you had likely a finish. Actually, the finish was probably right here. And then it re-engaged. Sellers, you can see the momentum through this low volume area. That's when you see that, you see the momentum coming through there, you're looking for a short back up at this low volume area. And you know, if I take this into from structure into print, go back to that level and just show you what happened. Price came through with all of this momentum, VCA showing activity, the volume of activity coming in at the bid, a little bit of buying. This looks like this was in fact releasing of inventory, and came back up, failed. We start getting strength back into the bid and lower. I love that toggle. So even in the volume profile for oil, here's the overnight. You can see trade opportunity here. Market opened, and you know, this was, oh, look at this right here, high volume area right there. There's responsive selling off the high volume area. Not a good sign for oil. What's a naked VPOC, I think, is kind of your question here. Let's just say for today, our VPOC right now is 2450. Let's say it ends at 2450, our VPOC, and it starts moving lower for the day, and it closes and opens below 20. Until this VPOC gets tagged, or we have activity at that level again, it remains naked. It remains open. And the probability is we're going to see that filled. I won't tell you that it's going to be the next day or the next day, but when price comes back up to that level, and let's say I'm in a long trade and price is coming back up to 2450 and it's a naked VPOC, trust me, I'm scaling out at 24. I'm looking for a bounce off of 24 quarter, 2450. May come through, but I'm scaling out in front of it. So a naked VPOC is just one that hasn't been touched in the RTH session. regular trading hours session. Yeah, I will, tomorrow morning I can show you the, we'll go through the opening and closing range and how I create those. But I wanted to show you the oil chart today and show you again that, you know, volume profile is volume profile. The attributes and the elements that you've learned today about volume profile, right? Finish, areas, low volume areas. You can see a distribution here, a distribution here. This is typically known as a double distribution day. If price now comes back over this level, you would look for a long. This might be at the end of the day, potentially back up to this high volume area right here. Otherwise, this was a short once it came through on a retest. And now with oil, I'm either looking for price to settle here, right around this 97, 38, 39, 40 level, or I'm looking for it to open the auction up and extend further lower, or I'm looking for this to come back above 97.65 and back up towards these high volume areas, back up towards the 98 area. So I can develop a, and I wouldn't do anything with oil until after 1 o'clock Central, 2 o'clock Eastern. But I can start develop a trading plan, and when I see activity in the print that supports one of those scenarios, if the scenario being supported is that it's likely to close around VPOC, I'm done. I don't do anything with oil. If we start breaking that auction to the downside and start opening it back up, then I'm looking for a short at that low volume area to take that. I would look at a longer composite to see where I would take that to. So a normal distribution, VPOC near center, good bell-shaped curve to the distribution. Price moves to and from high and low. Again, watch for signs that one side is holding more than the other. You'll see that in high volume area at one extreme or the other. And when price fails to get through VPOC and heads toward an edge, just know that that edge is at risk. So if you're into a day and let's say the morning we get this nice bell-shaped curve, we've got price moving above and below it and above and below it, and something happens around 10 or 10:30 or sometime, and price is moving lower, and it just gets stuck here, just stuck. Can't get through this area and starts moving up. Do not short the top of the day, because the most likely scenario is you're coming through. It's hard to take a long off of this area, but if you get a couple of prints that shows weakness at the bid down at VPOC, you can take that trade. Your risk is maybe a couple of ticks to the downside, because if it comes through, it's likely going to rotate lower. You don't want to be in the trade. But it's an opportunity. It's an opportunity because if this trade works and buyers step in and push this back up to the top of the day, you're going to scale here and you're going to be able to take this trade through the top of the day and higher. And you'll start to see another distribution start to build above it. All right. How about chart settings, templates for ES, CL? Yep, one of the things you're going to get are all my templates. You will get my templates. Do I mean 1 p.m. Central for CL? Yes. 2 p.m. Eastern. If I said Central, I apologize. 1 p.m. Central. After 1 p.m. Central, I'm looking for oil to either die around 97.39, or I'm looking for it to test. Here, let me just show you. I'm looking for oil to test here or down here. This actually might happen before that time. I'm looking for it to test here or down here. You got to be careful with oil. A lot of times this one of the nuances of this instrument is you go 3 ticks down below this level and 20 ticks in the other direction. You got to taking breakouts on oil can be one of the most pleasant, joyous, fantastic rides you've ever had in your life. But a lot of times it can be the most painful, frustrating experience you will have in trading as well. It's you got to be careful with breakouts on oil. Out-of-pocket experience. That's great. I love it. Brooks says it can be an out-of-pocket experience. Yeah, I can tell you, oil has. I like trading oil, but I'm very careful with it now, and I've added a couple of different nuances to my oil trading to help me with my get confirmation on some levels. So, but it can be very frustrating. The fact that a volume shift at the low, isn't that a condition indicative of acceptance? Long opportunity? Oh, that's a great question. So if price is moving lower and we get a volume shift, a VPOC shift, because volume means acceptance, isn't that a long opportunity? Well, I'm sorry, you're talking about a neutral day. You're talking about a neutral day, this normal distribution. If volume is shifting low, isn't that a condition indicative of acceptance? Here's what I would tell you. Like this, where you have this volume area way up at the top, if you have a volume area way at the top and you're seeing responsive selling and you've got a finish to the top, with this volume, huge warning flags to you that the reason this volume exists is because sellers are holding. If sellers weren't engaged here, then you wouldn't see this volume profile. What you would see instead is a better finish to this auction and likely buyers taking this into a new area. This volume right here is a strong, strong, strong signal that sellers are holding. And this, if volume is acceptance, this one at the top of this range is telling you that the risk is to the upside. Sellers are in fact holding good as this is coming down. Especially if you get a profile where it's shooting higher and all of a sudden you get a really short finish, but VPOC shifts to the top, and you get weakness in the print at the offer at the top, and you see strength coming in at the bid, go short. And here's the reason. If you think about what's happening behind the scenes in the auction, the reason that volume is being generated, think about it. No price is moving. Price is not moving any higher. Volume is being generated, and this happens a lot. Volume is generated in a big way. There's a lot of activity. If this were buying activity and this were aggressive buyers, then that would instinctively move price higher. But because price isn't moving higher, and we're seeing, again, if you look at the bid and you see weakness at the offer, strength at the bid, you see that coming back into the market, then this volume is telling you that sellers are starting to hold. The opportunity is for a trade back to center. And all you're doing again is in the print, if you get into the short trade, if you see strength coming back in at the offer, meaning you've got more buying, then you get out of the trade and say, in this case, I would say I'm not third time up. If this were to test like a third time up, I'd be a little careful. Third and fourth time up. But what you can say is, I don't need this trade here. I can take a look and see if I got a better trade here, because now my risk is small and my potential profit is even bigger. So don't be too proud. I mean, there's nothing wrong with taking a trade at break even and getting out of a trade. Nothing wrong with it, even if the trade works. I would rather have somebody read something going on in the print that puts their trade at risk and manage to that what they're reading, because it's telling me that they're staying objective and they're able to think objective, than to hope a trade is going to work and be happy, surprised when it does. Oh, that was a good decision. You can always get back into a trade. Yeah, I'm not good for nervous souls, guys. That's me. I love that comment. It can be an out-of-pocket experience. Have I traded the YM? I have traded the YM and the TF and the NQ, and I have found, and we can take a look at it on Friday when we look at other markets, that this volume profile works exactly the same. The profit in terms of ticks and points, I don't like it as much, so I don't trade it as much. But the volume profile, the elements, and the attributes work exactly the same. Would it be considered absorption due to the long wicks at the top of the can? That's another. Jimmy is asking, is this considered absorption because of these long wicks? And I would tell you, absolutely. This just shows you responsive selling, responsive selling back down into this area. All of this just screams that this market is going to start moving lower. In fact, let me just see something here. I believe, let me just see if I can do this. Yep, we're almost done here. This is that volume profile right here. See the VPOC at the top? Look at what happened to price. Really came down. All right. All right, so I've got this thing of volume profile examples, but we've gone through an awful lot of volume profile examples. I'm trying to think of what else I can show you relative to volume profile. We're going to get into different instruments on Friday, so I don't really want. If I start getting into different instruments today, there are going to be 10 million questions about the nuances of that instrument that I likely won't be able to answer, and we'll kind of lose what we have today, which is focusing on the elements and the attributes of the volume profile. So yesterday was, let's understand the principles of the auction and order flow, and once we understand those things and risk management, et cetera, and how to read the print a little bit, we read the print for point in time, trade confirmation. We look at the print for overall context of what the market's trying to do, how good of a job is it doing. And then we have a volume profile to provide us levels that give us opportunity for trade, and we use the print to confirm that. Once we have that set, now we can start putting these things together, especially with the other volume profile or OFA tools, and start building not only daily trade plans, but how do we go through the day as the market is developing, because we don't know how the market's going to develop throughout the day, throughout the rest of the day. We just don't know. So what can we do so that we are constantly in our minds saying, all right, this is what happened, this is what I'm expecting, so if this, then this. If price does this and I see this there, then that tells me to do this, or that the market's likely to go here. And so here's my next trade. How do we identify that? Because the more that we can do that, the less bias you will have in any specific market, and the more opportunity you will have to take advantage of trade opportunities. So I know if I get into a whole bunch of volume profile examples, and I've kind of already gone through a bunch today, we may lose the focus of today's teaching, which is the elements and the fundamentals, the attributes. So things like every volume profile has a finish. If it's not finished, it's likely going to be revisited. Every volume profile has a VPOC where the most volume is. Value is driven from VPOC. It's the first standard deviation or 70% of the volume away from either above or below volume point of control. Every volume profile has low volume areas. Even if it's a normal distribution, the low volume areas are on the edges, the top and the bottom. It also is has a high volume area and sometimes several high volume areas. And those high volume areas usually are part of an overall distribution that includes a bell-shaped curve. And that bell-shaped curve, the completion of that kind of tells you that an auction is gaining acceptance. So I want to focus on those things and give you time to absorb those things. And good. And give you time to absorb those things. I have a test that I'm going to send to DB, and he can get that out to everybody. So with that, I'll let real quick, a quick question of how do you draw the profile using the OFA tool? That is something I want you to be able to do without question. Let me just show you quick what you do to build the volume profile. You select volume profile. You just click it, left click. You put your cursor where you want to start the profile. What data do you want to start it at? You click your left mouse button and then let it go, and then just drag your mouse all the way to the end and click it again, and that gives you your volume profile.
Mark,
that's
I'm
how you create a profile.
I'm going to jump in here.
Okay.
Just because
great,
we have gone long again, and I don't mind that at all. It's my concern always comes down to the people who have scheduled this into their day, and
yep.
have some other place to be, and I don't want them to feel like, well, I couldn't, I didn't get all the information or have the opportunity to hear Mark live. So I do want to kind of cut it off. What we've done in the section where we're posting the videos is allow you to put comments or questions in the actual pages so that it becomes a class discussion. So anybody that's being part of this can actually post comments or questions. And I know it's difficult because of the way the videos were segmented yesterday for those of you who have watched them. But in the interest of time, it's very difficult for me to get 4 or 5 hours of video well edited. So we're going to continue to kind of use that path until we get through the week, and I can go back through where some of those comments may make more or less sense. But I don't want anybody to feel that they're not going to have their questions answered. I just know that we need to kind of put some sort of edge on this. Mark, you're more than welcome to stay in and answer some more questions. But in terms of kind of calling it a day for the actual class that's going to be recorded, I'm going to go ahead and have George stop the recording so I can get working on that end of it. And once again, I just wanted to thank you for the work and effort that you've put into this. It really comes across. I mean, today was very much an eye-opener for me. I hope it was for everyone else. Again, we really, we welcome the feedback. Constructive criticism is fine, and I think everything I've gotten so far has really been positive. But just wanted to say thanks again, and I look forward to tomorrow.
Awesome. I do as well. And thanks everybody for participating and getting the participating with your questions and comments. I look forward to tomorrow and specifically getting into Thursday. And when we get into Thursday and Friday, there's going to the aha moments. My expectation is the aha moments will really start to come. And my objective would be that you see, I don't want to say how easy this is because it just takes time to read the print and get used to reading the print. And I would tell you need to put the time in. But once we identify the levels, how easy it is to see what you're looking for to get into the trade and then to manage the trade. It's really not complex. In fact, one of my guiding principles personally is more is less, and less is more. So the more I add to my trading ideals and so forth, I get less results. And when I keep it pretty simple to these things, I get better results. So I'm going to send you this test, and you want to talk to how it might be distributed?
Yeah, as soon as you get it to me, I'll make sure that it goes up with the videos, so
Okay.
you guys can just continue checking that page. But all of the course material, we're trying to keep it very well organized. So if you just go to your course homepage in the client portal, all of this stuff will kind of be all right there. And so we'll make sure that it's, there's not. Did you want to speak to the homework at all? I mean, is there something that you want to
No, the
go over
test
with?
is really just to ask. It just asks questions. Most of them are multiple choice. Some of them are, fill it in. I would just ask you to go through it and do the best that you can to answer the questions. I'm not going to spend an hour tomorrow morning going through the answers to each one of those questions. But if there's something in the questions that stirs a question that is you need an answer to, then bring that question tomorrow and we'll go through it. So it's really for you to kind of remind, refresh, go through the last couple of days. The questions really are geared toward pulling out the basic principles and elements and fundamentals. That's what these first 2 days was about, so that we can move forward in doing trade planning and then actually taking trades. So
Okay.
tomorrow
Okay,
will be actual homework.
Okay, very good. So also, we're getting a lot of questions about chart templates. We'll make sure that those are there. I think, if you have been listening to Mark for the last couple of days, he has a really well thought out path of delivery. So don't feel like it's something that that we're forgetting about. I have a feeling that his method here is to give you what you need when you need it, and you need to put a little trust in him to do that. So we'll make sure that you have all of the course content, as it is revealed to you. Okay.
Couldn't have said it better myself. Well, thank you, everyone.
And thank
I
you,
think
Mark.
I'll be done, and we'll get the questions again tomorrow. Thanks for hanging with me. Is this really a 4-hour session? Wow,
Yeah.
awesome.
Yeah. It is, which makes for a lot of video editing. So I'm going to get after it because I got about 20 emails yesterday asking for videos within 10 minutes, and I just couldn't do it. So
I can attest to everybody. It is hard to do the rendering and the editing. It is hard. And I'm just glad we still have 56, 57 people.
Well, it's hard to walk away from good content. So thanks again. We'll see everybody tomorrow. Okay. Looking forward to it.
All right. Take care, everyone.